It's up to you. But you gotta
Say a
call it,
couple of words,
oh, okay,
thankful to God.
yes,
for
okay.
giving us this opportunity.
I appreciate that, yes.
No problem. Okay, we'll
Thank
start
you.
with you. Okay.
Okay.
Sound good? The Madeira Assessment Appeals Board meeting is called to order. Today is March 5th, approximately 9:05 a.m. We'll start with invocation and pledge of allegiance. Please all rise. The invocation will be done by our colleague Patty Gonzalez.
Heavenly Father, we thank you, Father, for this day. We thank you that you are a good God, and we ask that you be upon us, Father God, to give us the right choices and the right things to do. We ask this in your mighty name. Amen.
Amen. Flag salute. I pledge allegiance to the flag of
the United States of America, and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all.
Thank you very much. Please be seated. We start with the introduction of our staff. We'll start with our county council, and we'll go from here.
My name is Michael Ott, and I'm counsel to the board.
My name is Chai Cooper, Deputy Assessor for Business and Personal Property Division for the Assessor's Office.
Sarah?
Sarah Anderson, I'm your assistant clerk to the board.
Bob Rowe, and I'm a member of the Assessment Appeals Board.
Parmjeet Peetnichar, Member Assessment Appeals Board.
Betty Gonzalez, member of the Assessment Appeal Board.
Is there anybody in the public who would like to give any comments on items other than that is on the agenda? No one? Okay. We proceed. Next item is the consent of calendar and approval of minutes. We have any discussion on the agenda? No? Can we entertain a motion?
I move that we approve the consent calendar.
I second.
Okay, we have a second. All in favor say aye.
Aye.
Those opposed say nay. None. So motion is carried. We have approved the approval of the minutes and the agenda. The first item, we're going to first go over the non-hearing items quickly, hopefully, and then we'll come to the other items that are for here today for hearing. So next non-hearing item is 5B 5899, consideration to postpone hearing for Old Castle Precast Incorporated 19R017 to September 3rd, 2020.
Chairman,
Yes.
that's part of the consent calendar.
We've already done that.
Oh, okay, so we're done with that. Sorry. Okay, those are items are done. Okay. So there is no other item besides the, no, we have it. Okay, here. Item 6A 5743. Now, those are hearings. Is there any non-hearing item on the calendar? I don't see it.
Besides your stipulation of assessed values, non-hearing matters, staff reports, there are no other.
That's after the
Okay,
hearings, too.
so we are ready for the hearings? All right.
Yes, sir.
Let me see, the hearings here are for item, the ampersand Chowchala people, are they here? Are you ready with the hearing to go proceed with that? Okay.
Minister.
And, okay, let me make sure, so we know how much time we need today, because we are pretty busy calendar. Next item, the Mario San Paulo, are those people here?
Yes.
Okay, are you ready for presentation for the hearing?
Yes.
Okay, and, okay, you have two items. Then the first priority funding, those people here? Okay, you ready to proceed? Okay, sir. And the Bryce,
I think withdrawn.
oh, they have withdrawn, okay. So we have 3. All right. Before we start the hearing, I would like to go over the rules. Most of you probably know it, but I would like to just do it for reminder. Okay, these are just the rules. I'm going to read them. Please bear with me. The first thing we're going to do is swear in all the parties. And next thing we're going to do is,
Sir, let me go ahead and swear them in.
okay, go ahead.
Can everybody please stand, raise your right hand?
All those who are going to speak on any item today, please rise. And raise your right hand.
Do you solemnly swear or affirm that the testimony you are about to give is the truth, the whole truth, and nothing but the truth, so help you God? Thank you.
Thank you. Please be seated. Okay. The rules say that a request for written findings of fact must be submitted and fee paid before the closure of the hearing, or findings of fact shall be deemed waived. Okay. All testimony presented by the applicant or the applicant's agent must be conducted from the podium. When beginning to speak, first identify yourself. This is required for the public record. Since all meetings are recorded, please speak clearly and use the microphone provided. All remarks must be addressed to the Assessment Appeal Board. Conversation or debate between an applicant, agent at the podium, and a member of the audience or staff is not permitted. Both parties shall have the option to present an opening statement not to exceed 5 minutes, and the time will be recorded by the clerk. The party with the burden of proof shall present its opening statement first. Following the opening statements, the party with the burden of proof shall call its witnesses and introduce evidence. The opposing party shall present its witnesses and evidence in the same manner. For appeals assessed at less than 30 million per appeal, each side shall have a maximum of 3 hours to present its witnesses and evidence, including rebuttal, testimony, opening statement, and closing argument. Only relevant evidence is admissible, and when a witness is excused, he or she may be recalled only once for rebuttal of the opposing party's evidence. Applicants' exhibits shall be numbered in numerical order 1, 2, and so on, and the assessor's exhibits to be lettered like A, B, and C. And all exhibit pages shall be numbered in numerical order. The board shall not recognize objections on the grounds of hearsay, best or secondary evidence, opinion, calling for speculation, assuming facts not in evidence, calling for narrative answers, and authentication. All parties will conduct themselves with courtesy, dignity, and respect. Failure to timely object to evidence introduced shall be a waiver of the objection. The chairperson will make the final determination as to admissibility of evidence. After both sides have finished calling witnesses and presenting evidence, each may present rebuttal. Upon conclusion of the rebuttal, each party may provide closing arguments. Closing arguments shall not exceed 10 minutes. The party with the burden of proof may split its 10 minutes to open and close the period of closing argument. The board may announce its decision at the conclusion of the hearing or take the matter under submission to deliberate in closed session Notice of decision of value will be provided to the applicant, agent, and assessor's office in writing by the clerk upon determination. Are there any questions by any of the parties? Okay. All right. Having said that, we will proceed with the first item. And that one is the people from Emerson, Chowchilla. Go ahead, present your opening arguments.
Identify yourselves.
Yes.
Hi, my name is David Condola, and I represent the owners of the Chowchilla Biomass Facility, which is the valuation of it is at question here. This is not an item that the assessor's office has not looked at before. Both in 2011 and 2018, Senior Adjuster Mike Austin had reviewed all of the documents for these plants and had agreed to a valuation or assessment of $8 million. In 2011, when this was agreed to first, he agreed to an $8 million reduction. At that time, Mr. Austin did not tell us to change anything on our reporting information, that we're to continue to report at historical values, and those values were not ours, they were the previous owners. And just to give you a little bit of background on this particular...
One minute, excuse me. And this is going to happen more often. We will be asking you questions, interrupting you, so hope you don't mind. That's how we're going
Not
to
at
proceed.
all.
Could you tell your relationship to the company, how you are related? Are you an applicant, an attorney, or how are you related to that?
And, excuse me, counsel and Mr. Chairman, but I do note the rules you just read says the party with the burden of proof goes first, and that's right, that will be the applicant. I apologize.
The
for
applicant?
interrupting.
Okay, that's what I thought. Okay, sorry. Thank you anyway. Please keep us giving your advice. Okay. What is your relationship to the company?
I represent the owners.
Are you the attorney?
I'm not, I'm actually, I'm the asset manager for these
You work for the
this
company?
plant, so I work for the company.
Okay, thank you, sir. Okay, go ahead, proceed.
Sure. We acquired these plants on December 28th of 2010. At that time, the plant was shut down. It was out of business. It had a legal action brought against it by the state of California, the EPA, and the Department of Justice for excessive pollution. As part of the purchase, we agreed to pay the owners up to $1 million for the plants, and to pay, at that time, the lender, which was D.E. Shaw, $350,000 for their $41 million of debt. That gives us a total cost for this plant alone at about $450,000. And I have all the documents for you, which we put in binders, which if you'd like to review, you may.
Is this biomass company, is like a electricity producing company?
Yes, we have a 12.5 megawatt power plant in Chowchilla, which is at question. That's the plant that's in Madera County. And so we put some capital into the plant to make some repairs so that the plant could comply with the law, and we restarted it in June of 2011. At that time, we were also working with Mr. Austin to work out the valuation of the plant, the actual assessment. And if I could would you like to, do you want me to hand you the binders?
Sure, yes.
So you can look.
Any evidence you want to produce?
Just so we're clear, this is a section where
We're doing open statements.
you're supposed to make an opening statement, not present evidence.
Yeah, your time is being recorded.
I'll wrap it up very quickly then. There are three ways to assess.
The assessor needs a copy of your.
Oh,
So they only have 3 copies. They didn't provide copies for everyone.
That's fine.
So Chairman, if you wouldn't mind, after
It's
the
okay.
hearing, could you make sure you provide me your copy?
I will.
Thank you, sir.
No problem. and we'll share it here.
Okay.
Okay, and Sarah is recording the time for every party because we have a busy schedule. So
Right.
please try to keep
Sure.
your remarks within your time limit.
So there's three ways to assess the value of a power plant. One is through historic costs, the other is through the market value, and the third is using discounted cash flows. Under all three of those methods, these plants are significantly overvalued. And like I said, we've discussed this on two separate occasions with the county, and in both times they agreed with us. So the last time we discussed it with the county was 2018. So of course, we were surprised when 1 year later, they provided us with an assessment increasing our taxable basis by 50%. We contend that these plants have been overvalued since we first acquired them in 2010 and continue to be overvalued. As we get into the documents, you'll see that the county has assessed these at $8 million and seeks to increase them to $12 million, and the actual value of the cost is, actual value of the plants is somewhere between $1 million and $2.5 million.
Okay.
Thank you.
Thank you. Okay, Assessor's Office, your opening statement.
Well, I have questions for the applicants, if I may.
Could we just go ahead with your opening statement? or-
This is your time to present what you think your case is.
Further later?
Later,
Further
you'll be
later,
able
yeah.
to
Right.
question them.
I can present my case, yes. Good morning, board members. My name is Tran Cooper, C-O-O-P-E-R. I work in the Madera County Assessor's Office as a Deputy Assessor for the Business and Personal Property Division. I have worked in the Assessor's Office and Environment for over 21 years. I've obtained my appraisal certificate in March.
Excuse me, 1 second. Sarah, could you turn the volume up? Or is your
We're
microphone
not
on?
hearing you very well.
Yeah,
It is on?
Can you just
Can you
pull the
touch
mic
it?
closer
bring
to
it
you?
closer, yeah, okay, yeah. Sorry to interrupt you.
No,
Okay.
it's still the same.
It's on. Maybe I need to use another one.
Yeah,
Try again, Trang.
Testing.
there you go.
Yeah.
Okay,
Now
well,
you're
shall I
back,
start
yeah.
over then?
Yeah, go ahead,
Okay.
start all over. That's
Okay.
fine. Okay.
Here we go. My name is Tran Cooper, C-O-O-P-E-R. I work in the Assessor's Office of Madera County as a Deputy Assessor for the Business and Personal Property Division. I have worked in the Assessor's Office Environment for over 21 years. I obtained my appraisal certificate in March 1999. I earned my advanced appraisal certificate in November 2002. Ampersand Chowchilla Biomass LLC will be referred to as Ampersand hereafter. Ampersand is a power generation plant located at 16457 Avenue 24 and a half in Chowchilla, California. Ampersand sells its generated electricity to PG&E through a power purchase agreement. The plant burns agricultural byproducts such as pruning waste and orchards removal and construction debris such as urban wood chips to produce electricity. The plant has been in operation since 2008. With the latest amendment, the agreement to sell electricity to PG&E has been extended through the year 2031. The Clean Energy and Pollution Reduction Act establishes the clean energy, clean air, and greenhouse gas reductions goal. This act requires PG&E to have 33% of its power to be produced by renewable resources. And Ampersand's productions of electricity is considered renewable resources. So PG&E has to have a contract with Ampersand most likely in the future, extending further than 2031. Because in 2030, the increase in the Clean Air Act require 50% produced from renewable energy by PG&E. Rule 3 directs the applications of one or more approaches in order to arrive at fair market value in accordance with the Revenue and Taxation Code Section 110. There are three major approaches for estimating value. They are cost, comparative sale, and income approach.
Are we talking about year 2019?
Yes.
Okay.
So there are three approaches to value: the cost, income, and comparable sales. But there's no sales of this type of property that I'm aware of or no found. So we are not going to consider the sale income approach. Sale comparable approach.
Okay.
For the subject property, the assessor's office used the reported cost by the applicant to calculate the value. By applying a depreciation factor adopted by the Assessor Association for the plant equipment, this method resulted in the total value of $11,843,170. That's the cost approach to value. Oh, thank you. For this hearing, I have prepared an income approach to value calculation. This method is preferred and presented by the applicant. Using the same income and expense used by the applicant, the assessor's office shows a value of $11,837,750. The difference between these two approaches is $5,420. This is virtually identical in value between the two approaches.
The time's up.
Yeah.
Time's up.
Could you conclude your opening statement, and then you can come back to...
No,
make
this
it-
is my presentation, sir. I have introduction and then I went into my presentation.
So are you
Okay,
done?
This
no,
is my
they-
presentation.
The applicant is going to go present their case first, and then you're going to present it.
Yeah,
This was the opening statement.
This is just supposed to be your opening statement, a summary of what your case is.
Okay,
Then they present their evidence, then you present your.
I could do that. Then this is
You can summarize, what you think is the value. Okay.
the enrolled value of $11,843,170 is our assessed value using the income approach and using the cost approach and supported by the income approach.
Okay.
Thank you.
Okay, we got you. Thank you.
May I ask,
All right.
Madam Clerk, can you get a picture of this?
Oh, I have it in the exhibit, so you don't have to.
No, I mean for the video record, can we get it, is there some way we can get a shot of that?
Question, what is the value in 2018? 2018?
I have to look at my computer, if you just give me a
Yeah,
moment.
would you please provide us later on? Okay,
Thank you, Madam Clerk.
all right. Now, we're ready for the applicant. Go ahead, sir, it's your turn to make the presentation. Could you one more time state your name, please?
Yes. My name is David Candola. The last name is spelled K-A-N-D-O-L-A. DOLHA.
Thank you, sir.
And I guess I should let Ms. Trang state what the value was in 2018.
Okay, good.
Okay, sir. Go ahead.
Okay. As I stated before, the plant, which we'll call Ampersand, was purchased by us in 12/28/2010. At that time, the plant was shut down. It had been shut down for approximately 6 months and would continue to be shut down for a total of 1 year from 2010 to 11. And this was because the EPA and the state of California had brought an injunction against the previous owners to shut down the plants and not to operate until they could comply with the pollution control laws in California.
Okay, so your purchase price at that time was 1 million.
The purchase price was paid for in 4 separate tranches. There was a $350,000 payment to D.E. Shaw, which was the senior lender. This was actually for 2 power plants, one in Merced County and one in Madera County.
Okay, but what was the cost for this plant?
The total purchase price for this plant was $467,934.
And what was the 1 million figure that you told us earlier?
The 1 million was for both plants together.
Okay, so this plant, you value, your cost was 467.
Yes, in addition to that, we made some investment into the plant, but I can get through that all, but there's some investment made, so the total cost basis for this plant in 2011 was $2,580,617. And if you look at the front of the binder, there is an outline which gives you the cost basis.
You have a figure of 2,586,17.
Yes, that's 2A Roman numeral 5.
Okay. So this was the total of your purchase price plus the improvements.
Yes,
Okay,
yes.
all right.
And just as evidence, the plant was closed down in 2010. If you look at tab 7, there's a letter from the San Joaquin Air Pollution Control Board stating exactly that the plant was shut down because it could not legally operate in 2010.
So how long was it closed?
1 year.
1 year, okay. And then when it started to operate?
It started to operate in June of 2011.
Okay.
So when it shut down, like I said, the plant was in default and it was losing money. Under FASB ASC 360, it states that an impairment loss exists when the carrying amount of real estate exceeds its fair value. And the factors they say to consider are a significant decline in the market price of the property, which, as you'll see, there's been a significant decline in the market price of all solid fuel power plants in the United States. A continued decline in rates. As you'll see under our power purchase agreement, we could not increase our rates to PG&E. We sell our power at a fixed price, and that price is was set in 2010, and it cannot increase until 2023. And even then, the price increases are limited to the lower of 1.25% or 60% of the consumer price index, which means that relative to consumer prices, our rates are always going to be going down.
How much is PG&E paying you now?
This is, our PPA is subject to confidentiality, I have provided the PPA in your documents, but the PG&E, can I approach and tell you
Sure,
so that
sure.
it's not?
Sure.
Is it on the binder?
It is in the binder.
What area?
Let's see, it is tab 11.
Thank you.
I apologize, but PG&E considers that information to be confidential.
Well, in order to evaluate the property, we have to know the.
It's in there. Let me just pull out
Is it
the
chart?
document, and I can tell you
The
what.
one that, the chart?
It doesn't give you the generation, it's giving the,
It gives you a price per megawatt.
yeah, but doesn't give us the generation.
No, because the generation varies from year to year depending on how the plant runs and PG&E's needs.
Could you put a number, any number, approximately number, average income per year?
I can show you exactly what the income is. If you'll turn to tab 26.
It's on the top.
On tab 26, if you look at the last line, where it says cash flow from operations, that is cash flow before interest, depreciation, and income taxes. And you'll see that there is losses in 2011, 12, and 13. In 2014, the plant made a modest profit, but that was before debt service.
Okay, we see it. Thank you.
Sure. As I was saying, things to look at to determine whether or not a property is impaired. It was a significant decline in the market price of the property or similar property, a continued decline in rates, which we've seen from the way the power purchase agreement is, and I'll show you exactly where it's set out that this increases are limited. Failure to meet debt service, that is obvious as we purchased $41 million worth of debt from D.E. Shaw for $350,000. Known environmental contamination, that is set out in tab 7, the letter from the San Joaquin Air Pollution Control Board. Legal changes such as rent control or use restrictions. Once again, these plants have been subject to increasing environmental regulations put forth by the federal government and by the state of California. And so it has become much more expensive to operate these plants because of those restrictions. Looking at the first factor, the cost basis, we have discussed this with Madera County on 2 separate occasions. If you look at tabs 12, 22, and 13, I'll go through those real quick. Tab 12, you can see in 2011 that the value, if you look at page 2 of tab 2012, you can see where the Madera County had decreased the cost basis of the plant or the assessment from $14.791 million to $7 million.
Excuse me, board members and the chairman, we would object to, the assessors would object to having this entered as evidence. These are very old assessment. It has no relevance to the 2019 assessment.
Supposed to rebuttal yet.
Weren't these provided by you, by assessor's office?
Correct. But if you look at the years, it's going back to 2019 and 2008, which is not the subject of this appeal. And for personal property, we revalue them every year on each lien day as of 1/1/2000 of each year. So these has no relevance to 2019.
We understand, this is for 2011, we're talking about 2019. But as an evidence, what is your objection that why they can?
It has no relevance to the 2019. This number has no bearing on the 2019 assessment.
Okay. Do you have any objection, Bob, to produce evidence?
I don't have a problem with this historical information.
Yeah, I don't see any problem with it. I mean, that's their way of looking at it, that they thought 2011 was this much and now it's their rationalization.
Okay. Thank you for
Okay.
your consideration.
No problem, thank you. Okay, go ahead, proceed, sir.
Just as an aside, this is what the assessors agreed was the value of these plants back in 2011. And if you look at document 22, you'll see a follow-up conversation between Mike Austin and John Moffett, who is our accountant. '22. If you look in the third paragraph of the email, second to last sentence, it said total projected losses through 2009 have been staggering and have increased substantially since then. Net losses for 2008 were $6.2 million for 2009, for 2008, $13.2 million for 2009. And you'll notice that Mike Austin put a note on this email and said, auditors, I agree with the $8 million reduction in reviewing FIS and the income and expenses equals net losses. Reduce the cost by $8 million. That is the Madera County assessor saying to reduce the value by $8 million, which is reflected in the assessment for the property in 2011.
Okay, we see it.
If you'll turn to tab 13. This is a November 2018 email. If you look at the bottom of the page from Mike Austin, who is the senior assessor at Madera County at the time, and it says, John, I really appreciate your financials. Your data justifies the reduction in value for the past few years and the 2018 tax year. I have processed a tax correction today. You should receive a valuation decrease notice within a few days. I lowered the taxable value by $4.6 million.
Lowered it.
Lowered by, okay. Okay, we see it.
That was for 2018?
2018, yes.
Okay.
What was the final value in 2018, Mr. Candola?
It was the same as 2011, although it was adjusted for.
It didn't change from 2011 to 2018?
Do you remember?
Change, except for any
No.
purchases that were made from 2010 to 2018, those were counted as.
Can you please
You need to
speak
come
at
and
the
address.
podium? Please state your name.
My name is Tammy Arnold. We represent as CPAs for Ampersand. With regards to the property value, it was the same value as in 2000, assessed back in 2011, and it was increased for any purchases that were made from that period of time through 2018, which we accounted for on the property tax statement, and also accounted for any decreases with any disposals of assets during that period of time as well.
Thank you.
Just to answer your question, the value was approximately $8 million at that time.
So that was 2018.
That was 2018. And that was, just to be clear, that was an amount that we did not agree with, but were willing to settle on at the time.
So in 2018, you have already paid your taxes for that value?
Yes.
Okay. Thank you.
But as I stated before, the cost basis is based on the actual historical costs, which we'd already agreed to with the assessor's office in 2011 and 2018, that this property would be assessed at $8 million. Our contention has always been that this amount overvalues the property, that Madera's got a very good deal on this because the actual property is worth considerably less, as we'll see. The cost basis of the plants, there was, like I said, there was 3 tranches of purchase price made. The first was Exhibit 2, which is a $350,000 payment to D.E. Shaw to release their claim on both the Merced County property and the Madera County property. The second tranche was in Exhibit 3, and that was $100,000.
We're not seeing that. Where?
Oh, you'll see, if you look at tab 3, there are a series of wire transfers. I'll just sum it up. Those equal $100,000. Those were the instructions of the previous owner, which was California Biomass Fund 1.
Who is transferring the money to who?
This is the plants are actually owned by a limited partnership called the Acadia Environmental Fund LP. They own Ampersand.
So what are you trying to show us on this? Can you explain that?
Sure. I'm just giving you the evidence you need for the purchase price of the plant.
Okay.
Oh, that's the public price. Okay.
Well, that's the payment amount. How much did you say you purchased it for?
When you allocate the purchase price, the actual purchase
400.
price for the Ampersand facility was $467,934.
So this is the evidence for the payment?
That's correct.
Okay. See it.
In Exhibit 5, there is a 6-page spreadsheet which itemizes the actual cost to rehabilitate the Ampersand facility. That starts on the 3rd page of the spreadsheet. And when you get to the final page of the spreadsheet, you'll see a cost total for the historical cost basis of Chowchilla of $2,580,000. It's the very last page of the spreadsheet.
Okay, what is that number?
That is the purchase price that was paid to the previous owner, plus all improvements made to the plants.
What's the first number on the first page there? That 17 million?
That was what the previous owner spent to rehabilitate these plants. This plant, sorry. As you can see, they spent a lot of money, which evaporated in value. And the reason it evaporated is that they had problems with their original contractor who walked off the job, and they had to get somebody else to restart it. And they cut some costs, and they didn't operate the plants properly, which led to the letter that you saw from the Air Pollution Board saying that these plants were shut down because of environmental concerns.
By the way, what's the size of the property? How big is this property?
We lease the property. The entire property is 12 acres, which we lease. We don't own that property. The plant takes up a portion of that property. There's also a gas power plant that's on that property. And like I said, we lease that property for approximately $17,000 a month.
So the property value is all in the equipment and the business assets.
Correct.
Thank you.
Less the land, which
Okay.
I don't know what the land is worth, but it's not ours.
Okay, so you ready to conclude? I don't mean to pressure you.
No, I have a few other things I'd like to show you, if you don't mind. There is also market value considerations here. These plants are difficult to find comparables, but GE was considering financing this project, and so they had RW Beck come in and do a certified appraisal on these properties. RW Beck is a company that values power plants. That's what one of their things that they do. They're certified appraisers of power plants. And you can see in tab 8, their opinion of value back in
The assessor's office would like to object to this submissions of the appraisal, unless the appraiser is here to testify to what he was thinking and his value conclusion. I cannot cross-examine this appraisal on its face value.
Which appraisal is that?
This one right here.
Okay. Who did this appraisal? It was done by the applicant?
This was done by Ampersand. This was actually done for GE, General Electric.
Okay, so you hired them to do the appraisal?
We did not. GE did, a third party. They did this as part of a financing package they were considering.
Does it, right? The appraiser worked for the lender.
Right.
Uh,
So can we allow this appraisal?
We need to ask the council.
Council, can we use this appraisal?
I think it's entirely up to you. She's made an argument. You can decide if
What is your objection to it?
The objection is, this is an appraisal who was done by a person, and I'm assuming that person is not here for me to ask questions, how he come up with assumptions or valuations, how his thinking to come up with the value. In addition to that, the appraisal was done in August of 2008. We are talking about 11 years ago. The subject of the hearing today is the assessed value for 2019.
Understand.
Thank
I
you.
understand.
Thank
I
you.
guess we
Yeah,
have
that
to take
makes
it off
sense.
because you cannot cross-examine.
Okay,
So this-
well, can I
Sure.
speak? I would like to ask him, what's the relevance of this now for this valuation?
This is a business property of depreciable assets, that is machinery and equipment. This appraisal was done when the plants were first refurbished in 2018 and should reflect the maximum value of these plants. As you know, machinery depreciates and degrades over time. The reason I'm showing you this is simply to show that there's several ways to present this. One of the things that the appraiser did in this is they looked at the market value of a plant like this in the state of California in this area.
But the date on this appraisal I'm looking at is 2008.
That is correct,
Okay.
which should be approximately the maximum value of this plant because it was newly refurbished.
Okay.
And this
here-
is just to give you an idea of market value, because the market value of most plants is not transparent. And particularly in California, as we'll see, the majority of the biomass plants that have changed hands in the state of California have done so at scrap prices.
Okay, the objection raised by the appraiser for the appraisal done by General Electric, provided by the applicant, is sustained, and it will not be allowed in the evidence. Okay, go ahead, proceed.
So the second approach is market value. As we've both seen, prices can be somewhat non-transparent. These plants, as you can see from our costs earlier, this particular plant was purchased in 2018 for $725,000. Now, as you've also seen, it costs a substantial amount of money to refurbish these plants, this plant, sorry, by the previous owner, and you saw that value evaporated in that they spent approximately $17 million on these plants, on the Chowchilla plant, and we purchased it for approximately $500,000. There's a reason for that. The reason for low market value of biomass plants in the state of California is that PG&E is in bankruptcy. That's one reason. If you look at Exhibit 17, which is a Wall Street Journal article, it shows you that the courts have allowed PG&E to pull out of green power contracts. Exhibit 19 is an article from the Sacramento Bee in which bankrupt PG&E made a deal to cut the price it was paying for power to several solar developers.
Well, when you said the previous owner spent $17 million on that plant,
Yes.
what happened to that $17 million?
They invested in refurbishing the equipment, and they didn't complete that refurbishment. They tried to restart it. They ran out of money.
So they spent that and you inherited that.
Yes.
So you, for 407.
Looks like you got a good deal to me.
Well, you would think that, but that's actually not the case, because when you partially refurbish something and it doesn't run properly, it wears out. And so we had to reinvest a significant amount of money. In addition to that, the money that they spent, they overspent. The original budget to refurbish these plants in 2008 is set out in tab 20.
But when they spent $17 million, wouldn't you think you at least retained half of that?
No, because the plants weren't operating properly. They were subject to an injunction by the EPA and the state of California. They had to shut down. They had to make repairs.
I understand, but the money that was spent before by the previous owner, it was spent on the equipment. And that equipment was there when you purchased it.
It was,
So some of it, I mean, all of it cannot evaporate. Most of it should be there that you can repair and make it go,
He
right?
bought it for $450,000, though, at that date.
Right, because it was closed, it was not in operation, so you got a good value on that. You got a good deal.
most people would argue we did not get good value. As you can see from Exhibit 26.
We don't have to
is-
go to most people, we have to go to the experts.
Well, the experts was GE, and they said it was worth $725,000 after the refurbishment was completed.
Okay, go ahead, proceed.
Sure. But you can see the original estimate is set out in tab 20, and they're showing that they had estimated it was going to cost $4.3 million to fully refurbish the Chowchilla plant. The reason they ended up spending a lot more is that the contract, the original contractor ended up overcharging them and doing the work improperly, and it led to a very large legal battle where the contractor walked off, and they had to bring in a second contractor to correct much of the work that the first contractor had done, which led to a lot of cost overruns. And that's explained in the note from John Moffett to the county that we had looked at earlier from 2011. That was tab 22.
Yeah, we've seen that before, yes.
If you look at the second paragraph, it says, referring to that $17 million, they invested too much in the plant refurbishing it. The project was plagued with problems from the beginning. Construction was mismanaged and delayed by the general contractor, who was terminated midway through the refurbishment and replaced at a high cost. Total project refurbishment costs were approximately $8 million higher than originally planned. So the book cost of the plant bears no relation to the value.
Did they explain it to you? How did they arrive at the $8 million value or price? That reduction of $8 million?
It was essentially the email I just showed you that that the actual cost should have been approximately $8 million.
According to who?
According to Austin and
Did he-
John Moffett.
Did he provide any evidence to that? Any calculations, any comps, anything?
Yes. He provided costs in 2018 and 2011. I don't have the correspondence from 2011, but I do have the correspondence from 2018. But you can see in 2011, based on that correspondence, they reduced the value of the plant by $8 million.
Which number, which tab is that?
This is going to be tab 12.
Thank you.
And if you look on the second page, you can see the value history. They had it at 14.8 million in 2010 and reduced it by approximately 8 million down to 7 million in 2011. So there was a lot of correspondence that went back and forth. And you can see in tab 13 that Mike Austin confirmed that the value should have remained down because of operations.
Okay, all right.
Sorry, I just put away my outline.
Take your time.
We talked about the market value of biomass plants, and in California, biomass plants are shutting down. At one point, this state had approximately 50 biomass plants operating. There's now approximately 20. If you look at tab 14, there is an article saying more California biomass facilities are closing. In Exhibit 15, LA Times, biomass energy is out.
In the biomass plants, what's the raw material? Is it the wood?
The raw material is primarily the orchards that you see around. Orchards have a useful life of approximately 15 to 22 years. When they're pulled out of the ground, they could either send these orchards to a biomass plant to have it burned cleanly. They could put it into a landfill, or they can burn them in the fields.
Do you get it free or do you pay?
No,
for
we
it?
have to pay. It costs a lot of money to actually pull those trees up, grind them, and then truck them to a biomass plant. And so, yes, we pay for that because of the cost associated with actually pulling those trees out of the ground, transporting them, and grinding them.
So that's the main cost to the plant?
The main cost of the plant is twofold. It's the cost of personnel. Producing biomass energy is fairly labor intensive. This plant has 21 employees, so we have to pay salary, 401k, training, insurance, all of those types of things. In addition to that, fuel is also a significant cost.
Do you get any government subsidy, any assistance from the government to run these plants?
No, we do not.
Okay, thank you.
So at one time, they did.
Or they would be, because this sounds like a green energy producing thing, and then they are encouraging solar and green. So I thought they will be providing you at least free fuel or some assistance? So you're saying none?
None. In fact, as you can see from this article from the LA Times, is that the PG&E, San Diego Gas and Electric, and SoCal Edison are no longer signing agreements with biomass plants, and so the biomass plants are closing. In fact, the Rio Bravo facility is in its last years of its PPA. They have no hope of getting a new one. Delano is closed down. Madera Biomass is closed down. Dinuba is closed down. Tracy is closed down. I have a map, which is exhibit tab 24, which shows you the plants that are operating as of 2015 and all the plants that have been shut down. If you look at the map on, which is tab 24, the facility lists that are considered operational, this is in 2015. The very first one, Buena Vista. Yes, 24. Buena Vista is already shut down. Covanta Delano has shut down. Korea East West, number 12, is shut down. Number 14, Dinuba Energy, shut down. Pacific Ultra Power, number 28, their power purchase agreement expires next year. They will be shutting down. Number 31, Rio Bravo Fresno, their power purchase contract expires next year. They will be shutting down. DTE Woodland, number 52, shut down last month. This is not an industry that is going to be renewed. It's shutting down. That's why there's no market value for these plants.
So electricity production is kind of cost prohibitive.
From the articles, what's happened in this country overall is two things. First, the additional regulations on solid fuel electricity plants have increased. Because of that, many of the small marginal plants are shutting down. You've seen that just around the corner in Bakersfield. They've had 4 coal-fired plants shut down, in addition to the numerous biomass facilities in the area. The second is because of cheap natural gas. That is the fuel of choice right now for electricity generation in the United States. So because of the cost of operating solid fuel plants, it costs them more to produce electricity than what is the wholesale price is, and the wholesale price is determined by natural gas. And this is set out in the articles, but just to make it easy for you so you don't have to read through all of those, it's a twofold: increased regulations and the lower cost of natural gas. In addition to that, there is some pressure because solar is becoming cheaper and cheaper.
Excuse me, do you have any sales of these plants? Do you have any sales?
The plants that I mentioned all changed hands, but they sold at scrap prices. Basically, it's break even. When you purchase a plant like this and you shut it down, the only thing that has value in this market is the metal and the copper. That is offset by the cost of pulling out the foundation. It's very expensive to pull out a foundation of a power plant, but to restore the land, you have to pull that out. And so all of these plants that have sold, for example, Tracy, they auctioned off the parts for that for scrap. The value, the sales price is essentially zero by the time you pay to pull the foundation out. That is somewhat offset by the cost that you get for the metal and the copper. There is no market for the generator and the turbine, which are the most expensive components. And the reason is that the market is absolutely flooded with those. We have looked at costs of these generators and turbines. Most of them are being sent to China and Vietnam, but even then, it's very expensive to send those over and truck them across the country. So there's very little market for the components of value with these plants. As I mentioned before, there is a significant decline in the market price of properties or similar properties. That's one of the things you have to look at for a reduction in value. If you look at tab 17, you'll see that another solid fuel plant in Texas was reduced in value from $1 billion down to $300 million. And that is simply because of increased regulations and the lower costs of power. And this is something that all of the independent power producers are dealing with now that have any kind of solid fuel power plants in their fleet, is that when their power purchase agreements come up for renewal, the new price is going to be much lower because of the cost of natural gas. All this shale gas is in the market and is reducing the wholesale cost of power in the United States. And that means that for solid fuel providers that need a higher price to be profitable, their plants are worth considerably less. If you look at tab 16, you'll see an article from Bloomberg about how the Obama's EPA rules are redrawing the power production in the United States. And then finally, if you look at tab 11, and turn to page 3, you'll see in the very first paragraph, note A, for contract years 15 through 23, the energy price and capacity price shall both be escalated by the lesser of 60% of the percentage increase in the consumer price index, or 1.25% per year, which means that our electricity is sold at a fixed price until the year 2023, and even then it's capped at a price that's below the consumer price index, meaning our costs are going up faster than our revenues.
Were all of these conditions there on on January 1st in 2019? Were they already in effect?
Yes. There's nothing that's changed with this contract since 2011. And so when we were looking at, go ahead.
I meant as far as all the markets of the cheaper natural gas and that, were those conditions still the same?
Yes, this has been something that's been going on over the last, since the last administration, that you've seen solid fuel power plants pricing going down, the market price of those plants going down. And this has also affected the biomass industry in the state of California because with lower wholesale prices and lower solar prices, there's very little reason for a company like PG&E or SoCal Edison or San Diego Gas and Electric to enter into a power purchase agreement with a biomass plant that has to have a higher price. That's why you see so many shutdowns in the California market for biomass, is because they can't get the price they need to operate. And there are no government subsidies. You would think that because of the problem that you have with landfill in this state, that you would want to do something to have these things the trees disposed of in a clean manner, because burning in the fields is no longer allowed. Although that's changing. There will be burning in the fields because of the closures of the biomass plants. There's just no other way to get rid of the waste from all of these almond orchards that you see popping up all over California.
Okay, thank you.
As far as the third method, which is the discounted cash flow, this is the most common method used to appraise a power plant. And the reason it's used is that market prices are not very transparent and they're very site specific. They're dependent on the power purchase contract that you have. So in most cases, a purchaser is going to be unwilling to purchase a power plant for more than its discounted cash flow, because they wouldn't get a return on their equity if they do that. So we have put together a discounted cash flow model. It's a very simple one and it's tab 25. Our model started on Exhibit 25 using the actual cash flow for 2018, and this excludes depreciation, debt service, and income taxes. We used a consumer price index of 3.1% because that is the CPI for California. We used a discount rate of 8%, which is far below our cost of capital, which you can see an example of our cost of capital in Exhibit 27, which was a loan offer. Our cost of capital is somewhere between 1% per month and 20%.
In the expenses, is the depreciation included in it?
We subtracted that out in the cash flow. We did not include that as part of the cash flow. You can see depreciation is under operating expenses, and then it's taken out so that the net cash flow is the cash flow before depreciation, interest, and taxes. We also assumed no increase in revenue until 2023 because that's what our PPA says, and we capped our increases in revenue starting in 2023 by 1.25%. The net present value you end up with using all these assumptions is $1.197 million. Just as an exercise, in tab 26, I took the historical earnings of the plant from 2011 through 2018 and the projected amounts from 2019 through 2021 using the same assumptions and came out to a discounted cash flow of negative 3.269. So if you actually had this information available to you in 2011, essentially your assessed value would be zero. Now, the county also provided us with their cash flow in Exhibits 21 and 23. But if you look at document 23, you'll notice they arbitrarily excluded $1.9 million of expenses.
Mr. Chairman, at this time, I would like to object this to be entered into evidence. This was for when I was working with Mrs. Arnold to hopefully come to an agreement. These are assumptions that we made and run numbers to show that our assessed value is not far off. Since then, go through many revisions, and we still did not come to an agreement. So I don't see how our discounted cash flow is relevant in this case for presenting.
I'll just add that.
One minute.
Go ahead.
Your objection is that this is old document, or was it provided by the assessor's office?
I'm sorry.
How was it?
Is it from the assessor's office?
Yeah.
Yes, it is. I have generated this, but this was generated when we were discussing valuations and going back and forth to hopefully come to an agreement. This is just to show with different expense, different rate, we come up with different value. So it has no relevance at this time.
So
We are not
this-
presenting this. And
this-
I would object to have it into evidence.
Okay, so this was used just for discussion purposes. I see you have noted some numbers on it, marked it.
There have many revisions between back and forth, there's many between the applicant and myself.
Okay, I see it. I think, sure about
Can I just,
Let's hear from, before we.
it. Okay, go ahead.
I think if you look at their discount, their present value on item 21, it's the very last page. you'll see they came up with a present value of 12.7 million, which is very close to what they're considering right now as the cash flow value.
Is it the last page?
The last page. The very last number that you see, present value, 12,715,279. And also, we did not see the information they're providing to you right now until this morning.
Where did you get this document?
These documents? This was, document 23 was from the assessor's office. They came up with their own cash flow methodology, and we didn't know where they came up with the expenses, so they sent us an itemization of which expenses they excluded in coming up with their discounted cash flow.
Is this true that it was used for discussion purposes?
It was part of the negotiation, but at the same time, this is all I have to.
Yeah, but it never matured, so it doesn't have any value.
I think it does, in that if you look at document 21, the value that they came up with their model is very similar, 12.7 million, to what they're showing today. And I did not get a chance to review what they're showing you today, so I can show you the problems that they have in general with their discounted cash flow models.
Which will be shown to you when I present my information in detail.
I don't have a problem with we know the limitations on the purpose.
Okay, I don't see any issue with this. I would go ahead and sustain the objection.
Excuse me, can we discuss this? I mean, we know the limitations on it, so why don't we just include it too? We know that it was just part of coming to the conclusions of things, but I
think we just go ahead and allow it to go in, because it was just,
yeah, we know what.
Okay, so the ruling is overruled.
Okay. You can see, though, from the Exhibit 21 that they excluded from expenses approximately $1.9 million, and that led them to their discounted cash flow on 21, where they show a present value of 12.7 million. And it's very easy to make a property look very profitable if you exclude expenses. In addition to that, their calculation is flawed in that, as you see, the rent escalator is 1.25%, and they started that immediately. The expense escalator is also 1.25%. That's on the last page, I'm sorry, of 21. If you'll look on the last page of tab 21, and you'll look at the right-hand column, you'll see event date, January 1st, 2019, and you'll see the title rent escalator. Do you all see that? Yes. Okay, so you'll see they used a rent escalator of 1.25%. And if you look down at the table, you'll see they used that rent escalator starting in 2019. The problem is that our rent escalator doesn't start until 2023. The second problem with their discounted cash flow is they have an expense escalator of 1.25%.
Mr. Chairman, could I address or have a questions of the applicant at this time?
You will be given chance. After he's done, then you will make your presentation, and then he will get chance for rebuttal, and then you will get a chance for rebuttal.
Thank you.
No problem.
Just for your reference, I've included under tab 10 the actual consumer price index. And if you look at the column on the right, you'll see CPI for 2019 is 3.1%, estimated for 2020 is 3.3%, 2021 3.1%, 2022 3.1%. And the historic CPI for 2018, 3.9%. These assumptions matter because in discounted cash flow, if you're assuming revenues are increasing when they're not, you come up with a much higher discounted cash flow. If you assume that expenses are going to increase at a level below consumer price index, it's wrong. So under the discounted cash flow model, we believe our value is correct, 1.197 million. And we believe that these properties have always been overassessed. If you look at Exhibit 26, you'll see the discounted cash flow using the actual cash flow of the facilities is a negative number. We tried very hard to come to an agreement with the county to come up with an assessed value that was fair, and they were stuck on increasing our taxes by 50%. As you can see, we're not an overly profitable company. We have 21 employees in Madera County that all receive insurance benefits, a 401k matching, a training program, and are all receiving wages that are substantially higher than the average person in Madera County. Our entry-level position starts at $16 an hour. Our operators make up to $50 an hour, and all of our employees that work at these plants receive approximately 50% overtime every day. We work 12-hour shifts. We're paying significant wages and contributing to the county through that. We shouldn't be assessed an exorbitant amount of money simply because the county needs money. Thank you.
Thank you very much, Mr. Candola. And you'll be called for rebuttal later.
Right.
Okay, now, Assessor's Office, ready for your presentation? Okay, go ahead. After that. And after your presentation, we'll take a short break.
So as in my opening statement, the county's cost approach to value and the income approach to value are very close, almost virtually identical, of over $11 million. And those numbers, for this assessment for 2019, the assessors always presumed to have done his duties properly and value all the property in Madera County properly. At this time, would you please, Ms. Anderson, pass out the exhibit? Oh, thank you. Did you give them one? Thank you. Okay, so let's go over the exhibit. So these cost and income approach that the county came up with is exactly from the applicant's reported information. I have a package together, and it started out with a statistical information page of today's hearing, the assessment, the appeal numbers and assessment number as such. Do you see page 1? That's the summary of today's hearing. And the assessor's office recommendation is for the board to uphold the total enrolled value of $11,843,170. And the second, and I will go over the Merced County plan, but this is a summary of different approaches and the Merced County plan, which is almost identical with the identical valuation. And then page 2 is the table of content. This time, please turn to your Exhibit A, page 1. Do you see the title 2019 Power Plant Property Statement?
Yes.
Okay, thank you. This was signed by Mr. Moffett and submitted to the county under penalty of perjury that the information provided is true and correct. What the filing indicating, and I highlighted the cost in green. These are the reported costs for the plant as shown by the applicant. This is how much they say the equipment cost was. And the plant equipment cost is 15,478,748 and 1,891,773. So all that is reported by the applicant. The breakdown of those total can be found on page 5, 6, 7, and 7. 5, 6, and 7. So those details.
One second. The values you're saying here on the 2919 power plant property statement, are those numbers provided by the applicant?
That's correct. And signed under penalty of perjury that the information provided is true and correct.
Okay, so this, the bottom line, 15,478,748, is this number provided by the applicant?
Yes, everything on the first page and the whole exhibit, let me make sure that I'm saying it correctly. Everything in Exhibit A was provided by the applicant, CPA.
Do we have any evidence on that?
Oh, yeah, at the bottom where the signature, where it says signature of assessee or representative or agent, that's Mr. John Motford's signature. He signed it, dated May 7, 2019. I'm not sure if it's 7 or 1, but it's in May.
So where is he saying that these numbers were provided by the applicant?
Yes,
Where does it say?
yes.
Is this,
I'm sorry, what was the question?
where does it say that these numbers were provided by the applicant
Oh,
to the assignee? It's a property statement?
yes,
taken
it's a
from the
property statement. They need to file every year to the county.
Okay. Thank you.
But I noticed this, it also includes the land.
They don't own the land at this location. So there's no, it's just a title in total, it's including the land, but this location, the applicant does not own the land.
But that total of 15 million is the total,
A fixture, because it shows building fixtures, it's all combined into one line. So
okay.
it's actually for the fixture of the, so with the equipment of the plant.
Okay, thank you. Your mic is not working properly. Your microphone.
The breakdown of these total can be found on pages 5, 6, and 7. So, and are you at page 5? I can sort of give you an example what it means. So, for example, in 2011, under column A, the applicants, what the applicants telling us in this reporting is that in 2011, they purchased 1,046,167 in equipment of some type. So these are the total cost of each year that they acquire equipment.
wow,
Property statement.
okay.
Do you have any questions on these pages?
No, so that the total cost this is done by each, you have each year.
Yes, this is every year they acquire something, then they report it. The one that are empty, they did not have any acquisition that year.
So the totals at the bottom are from the year 2008 to 2018. The total purchase price, right?
That's the total, what they pay to purchase everything for all those years, yes.
Okay, so that number is 1.7 million, is that the one?
That's correct. That's the total of all the years above that.
Okay, go ahead.
Okay. Do you have any other question? These are the breakdown of the total costs that was on page 1.
We got it.
Okay, all right. Please turn your attention to Exhibit B, page 1. From those costs that was provided by the applicant in Exhibit B, we entered into our Megabyte. It's a program that we enter the cost into the system. It would apply a depreciation factor to it. So we enter all those costs into our system. And page 1 is a summary of all those costs that should be the same as Exhibit 1 on Exhibit A, page 1. All those costs calculated with the depreciation resulted in a value of $11,843,170. I have highlighted that in green also.
Now, you said you put it in the computer to come to the value.
Yes.
Do you use the same formula for all businesses, all properties, or is it different for different folks? I mean,
Oh,
it's
the-
like a plant. It could, some other things could be like a business, operating business, a retail business, cannot be compared with the manufacturing business.
I'm glad you asked because, yes, for each type of industry, the assessor association, all the assessors in California get together and come up with different depreciation for different industry, and that can be found in Exhibit C. And Exhibit C, it's just a portion, there's many pages, but the title of this is the California Assessor Association, January 9th, 2019. So these are all county follow this guideline. There's 58 counties in California, and we do follow these guidelines. And I have highlighted the power plant, or also known as cogeneration. The assigned life for this kind of industry is 20-year life.
Yeah, we see it.
So we use the reported cost by the applicant and the life recommended by the association, and that's how we came up with the value. Do you have any questions in Exhibit B or C?
Let me see, let me look at it carefully, 1 second.
So then you would then report this from 2008 when it was purchased to 2018? Is that how I'm understanding?
In a sense, because whatever the applicant's telling us on the property statement in Exhibit A, we used their number. We did not change anything. So because it was signed under penalty of perjury, and assuming everything they're telling us is correct, we did not change anything from their reporting. We just used their number and apply a depreciation factor to it.
Did they file any subsequent report after that, the one that you shown here?
That's the one reporting you, that's the only statement filed. Every year, one statement, they allow an amendment, but we did not have an amendment.
What about the year before?
What was the year before?
Uh-huh.
I could pull it up. It's
What was the
probably the same. Give me a moment, please. My computer went dead.
Correct, yes. Is it about the same, or is it? Check your mic.
I'm sorry. I keep going on and up. Yes, the 2019. Okay, how do we do this quickly? Yes, very close. 2018, the number is for C, plant and equipment. They have 1,888,117. And for D, building fixture, land and land improvement, is 15,478,748. So yes, the plan's actually the same.
So 2018, 2019, pretty much same.
Yes, very close.
Okay, go ahead, proceed.
Okay, so where are we? So we went over let me go back to Exhibit B. Exhibit B, page 8.
Page A?
Yes,
What?
number 8.
Oh, number,
Exhibit B, page number 8.
okay, thank you.
Oh, I'm sorry. Actually, it's number 9 to use the same discount rate as the applicant.
Is it B8 or B9?
Exhibit B, page 9.
B9, okay, got it.
Using the exact income and expense as the applicant and the exact rate, the value is 14,797,188.
So you based that on the income provided by the applicant for that year, 7,891,000? Sure.
How did you derive the cap rate for?
It's in general different industry. I have looked at the RERC. Our office use that. So for this type of industry, it runs between 6.5 to 8.5%. I use 8% because that's what the applicant had requested, and that's the only reason it's 8%.
Is that provided by the applicant?
Well, the applicant had mentioned it during our conference call that the cap rate is what they say is between 8 and 12%, but that's not supported by A.
Hold on. Okay, you have an objection? Yes. Yeah, go ahead, go to the podium.
Yes. Oh, sorry. The cap rate is hearsay in that she's discussing a conversation that we had. Second, we've presented evidence to the contrary of what our actual capital rate is, and that would be in, I believe, Exhibit 27.
But it's the same cap rate as they use.
Did you use 8% as cap rate on your calculations?
We did use 8%, and like I said when I was giving my presentation, that's not an actual cap rate for us. Our cap rate is much higher. 8% would be a bank loan rate that you could get if you weren't structured the way we were. When we have gone to the banks, they would not give us any kind of rate at 8%. Our rate is 15%. In addition to that, we're discussing a conversation that we had, which is hearsay.
So you would not like this to be used as an evidence?
I think the rate 8%, she's describing it as our cap rate. It's not our cap rate. This is an arbitrary rate that the county is using.
And how you come to the conclusion that?
But it's the same rate that the applicant presented for their income approach to value. I could show you if we use a different rate. That's why I have two, because I don't think it's hearsay. I was in the conference call. So, and also on page 8, the page in front of that, I use a cap rate of 10 because they did mention that between cap rate and I run different rate percentage. And even with the 10%, it's still 11,837,750.
I'm objecting to her characterization as it being the capital rate of the facility. It's not the capital rate of the facility. It's an arbitrary number. Our capital rates are much higher.
I just want to know, where did you have your proof of the cap rate that you have?
So tab 27 on our binder.
Where does it say that?
If you look on the bottom of the email, you'll see our lending rate of 1 to 3 months is 12 to 15%. Our lending rate of 4 to 6 months is 16 to 20%. That's 27. It's an email from Funding Merchants.
It's from Cass Advance.
I don't see it. Oh, is it the second page?
Yes, it's at the bottom of the first page. It's talking about if we took out a loan for 1 to 3 months, it would be 12 to 15%. And then if you look at the top of the second page, 4 to 6 months was 16 to 20%. Those are our capital rates.
Do you agree with that, Ms. Cooper?
Yes, these are short-term loans. It's like Cash Advance. It's like loan shark, but anyway.
Well,
These are
that's-
short-term loans, and I don't know what it's being used for. It doesn't say what it's going to be used for. I don't know. I'm sorry, but I would not go to Cash Advance for something long-term. This loan is not 1 to 3 months or 4 to 6 months. Sorry.
I don't expect
Well,
the county.
I'm sorry, I have to overrule.
Okay, that's fine.
Thank you. Okay, go ahead, proceed.
As I indicated, so page 9 and 10 depends on which rate you use, either 8 or 10%. It's either equal to the cost approach to value of $11 million and some change, or almost $15 million for this plan using the income approach, using exact expense and income as the applicant.
Anything else?
At this time, I also would like to point out, they did mention the Merced plan. The Merced plan has the same value as we do. And if you turn your exhibit D, I have summarized.
I'd like to object to any discussion of the Merced valuation. That's not before this appraisal board,
Well,
and it's
you
not
all-
relevant.
Say in Merced plan.
The assessor has not assessed that plant. She has not reviewed it. She has no knowledge of that plant, other than what's on the tax board.
We don't have any documents on.
Yes, we do. It's in the exhibit D, if you allow it. And I'm sorry to disagree with the applicant. The applicant did mention the Merced plan as part of the purchase. They compare the two plans, so I don't see why it should not be discussed, because the two plans are identical.
Was Merced plant a part of the deal?
No.
Wasn't?
Part of our, we don't, that's Merced County.
Or-
We're speaking on that objection. What is your opinion?
I don't really understand the question.
Oh, okay.
The assessor is trying to present evidence as to the assessment of a property that we also own in Merced County.
Right.
And
Why
she's
shouldn't
trying to
they be
use
able
that.
to do that?
What's that?
Why shouldn't they be able to do that?
Because first, she has no knowledge of whether that property is similar in any way. All she knows is that the assessed value is similar to what she wants to assess this property at. She hasn't been there to personally inspect the property and verify that it is a similar situated property. And in fact, she's already testified that there is no comparables for this property earlier, that they have no information on a comparable property. So the information on the Merced plant is not relevant here because she has no idea if it's a similar plant or not.
I
Only
have-
that we own both properties.
So your objection is basically a lack of foundation.
Correct.
Okay. And what do you know besides what you have on the paper?
Well, when I said there's no comparable sales, I didn't say there's no comparable property. Secondly, I have evidence that is provided by your accountant of the statement, the same statement that they have to file with Madera County, they file with Merced County. It's, if you look at the statement, so I do have evidence that they are identical plant producing almost the same amount of electricity. So yes, I did not allow, I did not ask to go physically to inspect the plant, but based on the reported information with Merced County, they are identical almost to the T.
So
Do you have the evidence from Merced County? Do you have
Provided by the applicant,
documents?
yes.
Or provided by the applicant?
Yes.
From Merced County?
Yes.
Is that true?
You're relying on what's in the public record with respect to
Well,
that.
I'm relying on what was filed with Merced County
Right.
by the applicant's CPA.
I think whether you let it in or not is up to you.
So is it that kind of evidence that is existing in the public record can be used as an evidence?
As a general proposition, yes, it's up to you whether you think it's probative in this case.
Okay, well, I guess we overrule the objection. Go ahead. It's
So-
overruled.
So you're not allowing?
No, we
You allowing? I'm not an attorney, so.
Neither am I.
All right, so if you turn your Exhibit D, page 1, I have taken the liberty to just summarize it, put it in one place. The first column is for the Madera County. The second column is for Merced County. And if you look at the total reported cost, it's almost exactly the same. And if you look at the highlighted valuation from both county, they are $15,000 apart. And our world with this much in valuation is virtually the same. And to show you how those total come about, we can turn to page 4. This is the property statement filed by the applicant. It's in Merced, it's under the name of Merced Power LLC. I took the number highlighted in yellow and transferred it to the page 1 summary, and that is what I get the information from. The productions is the same. If you look through every single detail, it's almost identical. And Merced County also used the cost approach to value, and the value is public information. If you have the assessment number, which I got from the statement, on page 3, I have highlighted the assessed value in Merced County in green. So those two numbers got transferred to the summary page on page 1.
Excuse me, do you know if the applicant has filed an appeal in Merced?
Not to my knowledge, according to the CPA, Mrs. Arnold, they did not file an appeal in Merced County.
I'd like to restate my objection to this information. As you can see, the applicants are different. One is Ampersand Chowchilla, the other is Merced Power.
Okay, thank you.
And it's signed by the same CPA, Mr. Marfet.
Anything else you'd like to add?
No, at this time,
Your microphone.
I'll get used to this. At this time, as you can see, the cost and the income approach to value using the exact number as the applicant, as they reported, as they presented, the value is $5,000 apart. It's identical. And this is, I did not vary in any way, shape, or form their numbers.
Okay, at this point, if you have any questions for the applicant, you can pose those, and they can answer those in their rebuttal.
Sure, thank you. Are we gonna?
Excuse me, Mr. Chairman, I wanted to interject. I think the objection made that this is a different entity in Merced than it is in Madera. I think that is a valid objection. I don't think we have any evidence in the record. They've referred to a Merced plant. Grant you, it's probably the same, but it's not the same entity, so I'm not sure that we have any evidence in the record to show that it is the same entity.
So are we, you suggesting we should review the earlier ruling?
Yes.
What is your opinion? Okay. All right, let me put in the record that the earlier ruling that we made on the exhibit, which one was that? The assessor's exhibit using the 8% cap rate, it was overruled. We changed that to sustained. Okay. Any questions you have for the applicant, so they can ask in the rebuttal?
You're referring to the applicant that the Merced Power Stake. Yes, he was referring to the applicant in that that county is introducing evidence of the valuation of the Merced plant. What council is saying is that that is a different applicant, and you should revisit the admission of the evidence of the value of the assessed value of the Merced plant because it is a different applicant. In one case, in the county of Madera, you have an applicant, ampersand Chowchilla, which is a different applicant than what the assessor is referring to. And so that's what he believes you should revisit, is whether or not to include the information on the Merced assessment, since it is a different applicant.
Have we included that?
But wasn't Mrs. Cooper mentioned that it was the same accountant that filed?
The same accountant who filed the statement for Bogue County, the applicant in his presentation mentioned that these two plans was purchased together.
That's
Even
what the
though it's a
applicant
different
said.
name,
Yes.
it's owned by Aikida, if I'm correct in my assumption. It's owned by Aikida also, even though they're different entities' name, it was purchased at the same time as stated by the applicant. They filed by the same accountant in Bogue County, identical plans.
Actually, there was one price for two plants, and then they split it. Is that correct, Mr. Kandari?
That's correct, but my point is that she's introducing evidence from a different applicant. That is, Merced Power is not the same applicant as before this hearing.
So what is your contention?
The contention is that any evidence on Merced should be excluded because it's not relevant and it's a different applicant.
Okay, so which particularly, which
I believe
evidence
it's
is that?
Exhibit C?
Exhibit C.
D. Okay, so Exhibit D should be excluded since it's a different applicant. It's not the same applicant. And Mr. Moffett, who regrettably is deceased,
D is Madera County.
Mr. Moffett did a lot of statements.
Oh, here.
It's simply that they're different
D3,
applicants.
You're talking about D3?
Yes, Exhibit D is a different applicant and should be excluded. We're only here to discuss the ampersand Chowchilla biomass assessment. We're not here to discuss Merced.
Okay, your objection sustained.
Thank you.
Thank you.
Oh, I'm sorry, I thought I was over with my presentation. There's one more exhibit I didn't go over
ahead.
with you.
Go ahead.
Exhibit E, if I may, just really quickly. The applicant has raised the fact that PG&E has filed for bankruptcy. Chapter 11 is for reorganization due to the fires up and down the state of California. It's not a liquidation bankruptcy. So on their website, on page 2, I have looked, and these are the frequent asked questions by consumer and their suppliers. The first answer was, We are continuing to provide safe and reliable electricity and natural gas service. We are not going out of business. So it's not like they're closing their door, don't pay anybody, don't provide electricity anymore. And if you look at the last page, on page 3 of Exhibit E, this is the supplier's question. Will supplier be paid for goods and services provided after the filing date? The question in short is yes. In the ordinary course based on standards and agree upon terms. So they are not going anywhere. If nothing else, they will continue to need ampersand because it's one of the only field left as far as renewable resources.
Okay. Thank you. Do you want to have any questions for the applicant so they can answer in their rebuttal?
Yes, I do.
Could you please read those?
Can we just take a break?
After that, right after that, we'll take a break.
Okay, let me gather my thoughts and I'll ask questions.
Or do you want to do it after the break?
Yes, please, if
Okay.
that would be better.
Okay, we'll take a 10 minutes break and then we'll reconvene.
Thank you.
Sarah, ready? Okay. Okay, we resume after the break. It's your turn, the assessor's office. Any questions for the applicant for rebuttal?
Your mic,
Yes, it's on. Can you hear me now?
I could hear you
Yes.
now.
Okay. In your testimony, you said that this plant, ampersand Chowchilla Biomass, was purchased in 2010. Who was the owner before that?
California Biomass Fund 1.
So mic is not on. Sarah, is it on?
I'm sorry, what was the name?
We're waiting for the slide.
Oh, sorry.
Okay. The name of the company that owned it previously was Ampersand California Biomass Fund 1.
So for 1/1/2009, ampersand Chowchilla Biomass was not the owner of this plant?
That is the entity that owns the assets. The actual owner of Ampersand Chowchilla Biomass was Ampersand California Biomass Fund 1.
Oh, okay, thank you. Okay.
So
Any more questions?
Yes, a lot more.
Okay, great.
I have a 2009 that's filed by ampersand Chowchilla Mass. So it's sort of contradict to different ownership. So I am still confused as to what's the different ownership. It's the same ownership at least since 2009.
Well, this was structured as a membership interest purchase agreement. So the actual owner of the assets, Ampersand Chowchilla Biomass, was purchased. The LLC changed hands, but the owners were different.
Okay, could you turn to my Exhibit A? 2019 power plant property statement.
Yes.
You testified that you did not start operating until June 2011. On the statement filed by your accountant, signed by him under penalty of perjury, have an operation date of May 15, 2008. Is that not correct?
That was when the plant started operating in 2008, and they shut down in June of 2010. And I provided evidence documenting the shutdown of the plants in June 2010. That was Exhibit 7. That was a letter from the San Joaquin Valley Air Pollution Control District stating that the plant shut down in June of 2010 due to environmental concerns. The plant was reopened in approximately June or August of 2011.
And now I'm going to go back to your exhibit. You use a rent escalator of 3.1%.
That's the inflation rate, and we've already provided the evidence of what the CPI should be, the Consumer Price Index, in the state of California. That was Exhibit 10. That showed the actual Consumer Price Index numbers for the state of California and for the U.S. as a whole.
But your reported expense has an average of reductions of 5%. Why did you not use the negative 5% for the expense?
Expenses vary from year to year, but like any facility, we're subject to inflation. There are things that we can change, and there are things that we can adjust, but overall, the prices will increase by the cost of inflation.
But your actual expense, which you use for your income approach, projecting it through 2031, is not actual.
We used the actual expenses in 2018, and we projected those out using the rate of inflation. Operating costs on the biomass plant are like any plant. They're much higher at the beginning when you first start operating because there's things that you have to fix. There's things that you didn't know were not repaired, so your expenses are always going to be higher at the beginning. But like any business, we're subject to inflation, and our costs will continue to go up because we have employees. Anybody who's hired anybody knows that the cost of employees is going up considerably in the state of California because of the low unemployment rate. In addition to that, insurance costs, which we provide health insurance for our employees, those have been going up at greater than inflation. In fact, they've been going up about 8% per year for small businesses in the state of California. The price of diesel that we use for our loaders and other materials is going up. So the idea that we're not subject to inflation is just false. We did have some higher costs at the beginning because we were a new power plant starting up, but to say that we should use negative inflation is just incorrect.
But over the last 5 years, if you were to use a trend on actual expense, it would be a negative 5%. My next question is,
and as I've always shown, if we use historical costs to come up with a discounted cash flow, it would come out to a negative value. I've shown that in Exhibit 26. You can see with cash flows, they have increased in the plant if you compare 2011 to 2017, but at the same time, we had negative cash flow. So to say that somehow we should be using negative inflation on this project is just not logical.
just on your actual average reduction, but I understand your point.
You can look at 2017 to 18, expenses went up approximately, 5%, up about $400,000.
But if you look at between 17 and 18, reductions of 11% 11.12%, and between 15 and 16, a reduction in expense of 25%. Or so we can go back and forth, but as on average, it's negative 5%. And in 2016, the reduction was really negative 25% in expense.
As I've stated before, there were higher operating costs in 2011, 12, and 13. But if you look at 2017, our costs were $6.3 million, and in 2018 were $6.7 million. When I discussed biomass plants shutting down in general, one of the things that happened in the biomass market, and you can see this from looking at the cost of fuel, is there was a significant decline in the price of fuel between 2015 and 16. That was a function of demand of biomass fuel. There's a significant number of biomass facilities in this area that shut down in 2015, so we got a little bit of a benefit in that fuel prices came down, but everything else is going up, and fuel prices have remained flat since that time. So because of a historical blip, which is included in my Exhibit 26, showing the actual cash flows of the facility over the last 10 years, you can see that there are many costs that have gone up, and significantly, 2017 to 18 costs went up. But the assessor is assuming under their discounted cash flow that costs remain at 85% of revenue, and that our costs are not subject to this rate of inflation for the next 10 years. No business gets to do that. All businesses have to pay higher wages from year to year. All businesses pay more for their supplies. All businesses are paying more for electricity over time. The idea that somehow we're going to have a negative inflation rate for our business only and not the others in California, that just doesn't make sense.
Okay. Could you turn to your Exhibit 22?
Yes.
This is going back to 2011, which has no relevance to this hearing, but since you have submitted the information, 1, 2, 3, third paragraph, starting with second, the last sentence. What is the capacity at that time?
In 2009, the plant capacity was 47%.
What is the capacity for the calendar year 2018?
It is 2018 was approximately 71%.
So almost double, close to double.
That's correct, but when you operate more, what ends up happening is what you saw in 2009 was there was, and that's in Exhibit 26, there were significant losses in, I'm sorry, I don't have Exhibit 9, that we didn't, I don't have 2009 numbers in front of me, but yes, that's all part of what I was explaining earlier, that these plants essentially went bankrupt back in 2010 and were shut down because of environmental concerns. One of the reasons that prevented them from operating as much in 2009 was that they had excessive emissions, excessive pollution, sorry, and so they did not run as much as they should. But in 2009, they still had to pay for employees to be there every day. They still had to pay for the operating costs of the plant when it operated at that level. One of the reasons that we had such high operating costs in 2011 and 12 and 13 was trying to fix all of the different problems with the plant. This is a very complex machine. If any of you have ever bought a used car and decided to do some repairs yourself on it, you know how difficult it can be to get everything fixed. This is a power plant. It's very complex. It takes a while to figure out everything that needs to be fixed. But even if we did double the capacity, you see that reflected in the numbers in Exhibit 26,
So,
the
and
plant
what,
still had a negative value in 2011.
yeah, so the lower value at that time was because it was at 40% capacity, which is now almost double. That should significantly reduce the value, and I can see that, but the capacity now is not 47% anymore.
And it wasn't in 2011 either. We're looking back, you're looking at 2009 when a different company was running these plants and owned these plants. So I'm not sure what the relevance is of the capacity at this point.
So, in,
I'll add that in 2018, when the county agreed to the previous valuation, all this information was available to them as to what the capacity of the plant was, and they still agreed that the plant was not worth $11.7 million. They gave us a $4 million adjustment in 2018.
Exhibit 25, please.
Yes.
Why did you use the 8% cap rate?
I wanted to use something conservative. I could have easily used a much higher number when would have been justified by the plant itself. I don't know if any of you have ever run a small business, but going out and getting a loan, it requires you to get, if you want to go through a bank and get an 8% rate, it requires every one of the owners to sign off on that and provide personal guarantees. Our business is set up as a limited partnership. Our limited partner specifically will not take responsibility for anything other than their invested capital, which means that for a commercial lending loan from a bank for a small business like ours, they're just not available because our limited partners won't enter into that. So the commercially available rate for us is somewhere between 12 and 20%. That's just a fact of business. And we talked to Chase Bank about it, we talked to Bank of America, and we talked to U.S. Bank, who we have a very long relationship with, and none of them would loan us to us at 8%. 8% is an arbitrary number. It's not our capital cost. Our capital cost is significantly higher.
But whatever we submit to the banks is considered to be a fact.
To the banks?
We submit facts
Yes,
to the bank.
yes.
We're not lying to the bank, are we?
No, no.
So
That's why we can't, we're not, that's why, I'm just telling you why a commercial loan at an 8% rate's not available to us. And we don't have commercial loans from a bank. If we did, then the cap rate of 8% would be an appropriate capital cost for these plants. 8% is an arbitrary number that I chose. It doesn't reflect the capital cost of the plants.
Why?
Because of the structure of it. First, small business lending was reduced significantly in 2008. The banks had to turn to, they were restricted as to what they could have in their loan portfolio. That was all part of the mortgage crisis in 2008. Significant regulations were put on banks as to what they could hold. So the banks changed their lending requirements to small business starting in approximately 2009 to 10. Those requirements then require the banks to hold loans that are primarily guaranteed by the owners. So if you want to get a business loan from a bank, you have to get each and every one of your owners. Somewhere for U.S. Bank, it was 100% of the owners had to enter into personal guarantees. For Chase, it was 80%. And then for Bank of America, they wanted 85% of the owners to sign personal guarantees before they would provide commercial lending at rates of somewhere around 8%. Since we're unable to do that because our owners are limited partners, we have to go to a different type of lender, a lender that has higher rates.
Okay, now have you concluded as to what's the estimated value of the property in 2019?
In 2019, we believe that Exhibit 25 reflects the true value of the plants, approximately $1.2 million. And under a cost basis, the value of these plants should be $2.6 million. I would also like
That's
to,
based on the income?
that's based on the income, yes.
Okay. Now, the assessor's office is using the same method, and they're coming with 11,837,000. Why we have this huge difference?
I can tell you
That's why I
why.
asked you.
Yes, is the assessor's office is valuing an annuity. That is a instrument that gives you a fixed amount of income each year. And so their calculation doesn't include inflation. It doesn't include a normal cost of business. It's showing flat cash flows for the entire length of the power purchase agreement. That's not the way it works. With a discounted cash flow model, you have to include inflation for your expenses. The county did not do that, so they have misstated what the actual discounted cash flow of this plant is. When you look at a discounted cash flow on a plant like this, first you have to look at what does the power purchase agreement say as far as increases in revenue. And what the power purchase agreement says is revenue doesn't increase until 2023. And even then, it's capped at 1.25%, or if inflation is lower, 60% of inflation. So we have revenues that grow at a lesser rate than inflation. And the county did not reflect that in their model. Therefore, their answer is incorrect. What their model shows is what an annuity would return. We're not an annuity. We're subject to inflation.
Thanks.
But-
And your answer?
My answer would be if you want to use actual in your calculation, you don't know what the next 10-year actual expense will be or the income will be. So for you to use an actual expense and income projected out with a guess, it would not be accurate because next year it may be a lot lower. As you can see, 1 year the expense went down 25%. So if next year the expense went 25% down, but on their discounted cash flow, it shows an increase of 3.1%. That in itself is inaccurate, using an actual number and projected out without knowing what the actual number next year will be.
Whenever you have a certified appraiser that's making an appraisal, they have to make assumptions. That's what a certified appraiser does, is they make assumptions about how costs are going to change in the future. That's the nature of a discounted cash flow model. That's the nature of what are your cash flows going to be. And I have done the historic cash flow model and shown that the plant had negative value. So when the county says that you can't assume what inflation is, that misstates what appraisers do. When they make an assessment, they have to assume what inflation is going to do and how that's going to affect the expenses of your business. Further, our business, the amount that we can charge is defined by our power purchase agreement. So our revenues are capped under that power purchase agreement for years 2011 through 2023. They're not going to increase. The county assumed that our revenues would increase each year by 1.25% and that our expenses would be 85% of whatever the revenue was. So in other words, they're showing that revenues are increasing at a greater rate than expenses. That's the way the math works in theirs. So of course you're going to have a much higher discounted cash flow value. In reality, what is happening with these plants, and this is shown by a certified appraiser that specializes in power plants, is that inflation is causing expenses to increase at a faster rate than revenue, which means that these plants, the cash flows decrease each year. That's just the math, and that's the way certified appraisers work.
Okay, so Ms. Cooper, your calculations for 2019 are based on the income produced in 2019 and expenses.
Yes, just like the
Purely based
applicant
on
used.
2019.
Yes, and if I could point out before, may I get my question in? Oh, I'm sorry, go ahead.
Let me finish, then you can answer. And then 2018, did you use the same method for 2018?
We did not use one in 2018. There's no note as what as to why Mr. Austin think it should be reduced. We could not find any note in our file to say why. Answer your question in short, no.
2018 assessed value was close to the 19, was it pretty close to it?
It's about, I think it was around $8 million for 2018.
And then we went from there to 11 million in 2019 based on the income.
No, based on the cost, we have been using the cost approach to value, and Mr. Austin have reduced it by, however, there's no record, there's no documentation that I could follow as to why he justified the reduction.
We see. Okay. Any other question for the applicant from the assessor?
Well, I just wanted to point out that the applicants say, well, we are guessing the income and we are guessing projecting increases. But then he used actual because the net income that the applicant uses is not calculated on the gross production. It should be done that way to have true reflections of income and expense if you project it out. So if you calculate it on net instead of gross, that's already reduced the gross revenue. That already discounted, but then he calculated the expense projected out with an increase, but without showing a gross revenue, which would be higher because what the income show is a net, not gross, and gross should be calculated.
Okay, thank you. So, sir, do you have anything to add in your rebuttal?
Yes, I do. First, it's inaccurate to say that Mike Austin didn't provide any notes on why he reduced the value or continued to hold a reduced value in 2018. We've presented Exhibit 13, where Mike Austin, on November 1st, 2018, wrote to John Moffitt, who was our accountant. He said, "I really appreciate the financials. Your data justifies the reduction in value for the past few years and the 2018 tax year." That's the first sentence of his email. So clearly,
Well, he hasn't substantiated with any evidence, any calculation or anything. I see that memo here. We all see it, but we don't see any calculations, any basis for it.
that information would be in the possession of the county.
So it's
And
yours.
so if the county can't produce that, we know the evidence is there someplace. Simply because they lost it or can't produce it doesn't mean that this email is not relevant. Mike Austin was a senior appraiser at the county and was there until he retired.
Who's
Now,
no longer with the county.
He retired, but at the same time, the county should have that information. I can't produce something that the county possesses.
Well, if
But
if you produce it to Mr. Austin, you should be able to reproduce it also at this time to back up to show that financial shows that the reduction was justified.
And we have provided that financial data. If you look at Exhibit 26, you can see the actual information on what the amounts were. In addition to that, Exhibit
Okay, I guess we're approaching to the 3-hour limit, so we should be concluding.
Yeah, let me just, like I said, Mike Austin provided, he obviously made an adjustment in 2011 and in 2018. I assume he didn't make that as an arbitrary decision. He based it on information that was submitted to him. Unfortunately, this is a communication between John Moffitt, who is now deceased, so I can't get his information, although we do have what the assessor's report from 2018, which shows that the projected income was around $1 million, or the 2018 was around $1 million. But just a couple notes on what the assessor has told you. When we submitted Exhibit A, this is under penalty of perjury. And if you look at page 5 and 6, you'll see that what we submitted were the costs that the previous owner had submitted. So the 14.79 million on page A6 for cost, that was submitted by the previous owner, and that was their cost. When Mike made an adjustment in 2011, which you saw in Exhibit 12, where you saw the actual reduction he made from 14.791 million down to 7 million. That was made on the county's books. We were not given permission to start using a number other than historical cost on the assessor report, on this 2019 power plant statement. Mike never gave us permission to use anything except the actual costs that were incurred in those years. These are historical numbers. They don't reflect the value of the plant. This is simply what was spent in 2008. And when Mike reviewed that in 2011, he determined that the value of the price of the property should be $7 million. The fact that we continue to report on the historical cost doesn't mean that's an assessment of our value. It means that under penalty of perjury, we have to report this.
Okay.
If you look, the investment we made in 2011 was 1.46 million plus 5,228 and plus 91,000. We have been reporting this information as to what we spend accurately because it's under penalty of perjury. This does not reflect the cost. This does not reflect the value of the plant.
You'd like to reply there, Ms. Cooper?
Yes, I would like to show, the applicant keeps saying historical costs, and that's what they are told to report. It's reported by a CPA, a certified public accountant with license to practice in California. They know more about what needs to be reported than anyone else should be. But if I could show you and present it to you, the historical cost was actually $22,525,000, not what's being reported in 2019.
Where does this come from?
From your statement.
No, was this in this exhibit, though? Oh, this is 2009. This isn't our statement, this is the previous owners. This is irrelevant. I can't tell you what, I can't tell you what this document is because it's not ours.
That's signed by Mr. Moffett.
My point is that
It's the
this
previous
facility changed hands in 2010, and this is not something that has been presented to us. This should be excluded from evidence.
Well, you mentioned historical costs from the previous owner. I think it should be allowed because you mentioned historical costs, and that's what you follow, but it's actually historical cost is $22 million. So you cannot say, well, I am reporting their historical costs and not allow it to be into evidence. The historical cost is $22 million.
This is 2009, and the applicant purchased it in 2011?
December 28th, 2010.
10.
And as you can see from Exhibit 12, the county has already agreed that in 2011, the assessed value of this plant was it was under $8 million.
Okay. All right. Anyway, go ahead, proceed. Yeah. Are you ready to make your
Oh, I just have,
final statement?
sure.
Madam Clerk, do you have a copy of this?
I do now.
We should mark it as Exhibit F.
Submitted by, yes, sir.
Okay, we're going to have now the conclusion statement, first made by the assessor's office and then by the applicant. Are you ready for your 10-minute?
Thank
applicant first and then the assessor's office? Thank you. Okay, sir, your turn. You have 10 minutes to conclude.
Okay.
In conclusion, the county has agreed on 2 separate occasions what the assessed value of these plants was. And in both cases, they assessed it at under $8 million. In both cases, the county looked at all the financial data, and their senior assessor, Mike Austin, agreed that the assessed value should be less than $8 million. That was done in 2011 and then again in 2018. With normal depreciation on a 20-year life property, it is now 2020. The value should be, even under the county's method, should be approximately 50% of $8 million. That's using the county's numbers that they agreed to in 2011 that you've already seen from the assessed statement. As you've seen from the discounted cash flow statements, which is Exhibit 25 and 26, in 2011, if you use the actual cash flows, the plant had negative value. We obviously made a poor investment. If you use the numbers from 2018, the actual expenses and actual revenues, and project those out using what a normal appraiser would use under discounted cash flow, that is the rate of inflation subject to the state of California of 3.1%, and the inflationary numbers for revenue, you come out with a discounted cash flow of approximately $1.2 million. This is what appraisers do, is they use assumptions to come up with value. This plant has a historical cost basis to us, the current owner, of approximately $2.6 million. I would tell the review board that we've heard evidence about PG&E that they're going to remain in business. I agree. They're going to continue to deliver electricity to you. They're going to continue to buy electricity from suppliers like us. What's the question, though, about reorganization in bankruptcy, and which creates uncertainty, is we have no idea what price they'll continue to purchase our power at. It may be at a power price that is too low for us to continue to operate. Part of reorganization is cutting costs. The easiest way for PG&E to cut cost is to reduce the purchase price they pay to suppliers like us. The county is seeking to increase our taxes by 50% after agreeing to a number of under $8 million last year. 50%, there is nothing that justifies increasing these plants by 50%. The fact that we reported the way we're required to, showing you historical costs that we've used in the past, has nothing to do with assessed value. And that's what the assessor is trying to tell you, is that somehow we, under penalty of perjury, submitted the market value or the actual value of these plants. We didn't. We just reported what the previous owner had told us they paid to refurbish these plants. In 2011, when the county reviewed that, they determined that that was not what the value of these plants was. In conclusion, there's 3 ways that you could assess these plants. One is historical cost based on assessed value. The assessed value in 2011 was $8 million. That should have been depreciated over the last 10 years, giving you a assessed value of $4 million. The other way you could do it is through our cost basis, under which the plant would have a value of $2.6 million. That should be also depreciated over 10 years, coming to a value of 1.3. Or you could use a real discounted cash flow model that reflects inflation and the growth of revenues that we have based on our power purchase agreement, under which the value of these plants is $1.2 million. Once again, the county wants to raise our taxes by 50%, and there's nothing out there that justifies it. The other biomass plants in this area are closing, if they haven't already closed. And there's been a number of them. In fact, there's one right here in Madera that's been shut down now since, I believe, 2017. The biomass industry is declining in the state of California. Back in 2008, there was approximately 45 plants operating. Today, there's around 20. PG&E is going through reorganization, which creates uncertainty. We have no idea if PG&E is going to continue to purchase our electricity at a price that will allow us to continue to operate. All of these create uncertainties. There's no justification for increasing our taxes 50%, and there's ample reasons to reduce our assessment down to a reasonable level that reflects the value of these plants. Thank you.
Thank you very much, Mr. Condola. Appreciate. You may be seated. Okay, the assessor's office.
Thank you. To just point out a few things, and in my closing, 2011, the plan was in non-operation state. So it seems to be justified the reduction. For 2018, I cannot say to it, the person who did it is no longer with the assessor's office. In the case of the PP, the purchase power agreement, Mr. Condola stated that, close that, we're not sure of the future. At that time in the future, we revalue this plant if it's still in operation, and at that time it will reflect whether the market value at that time is. And he said these plants, including the Merced plant, but he wouldn't allow that into evidence. I believe that the applicant has not met their burden of proof that any lower value than the enrolled value is warranted. As you heard applicant testimony and the nature of the income approach, it requires careful application. Small changes in its key variable can be mathematically leveraged into a wide range of estimated value. The accuracy of the income approach depends on the validity of the assumption used to estimate its key variables. Therefore, if the assumption is not accurate, so would the results. And I'm going to just outline some of the assumptions made by the applicant income. Assumptions made by the applicant income approach to value do not reflect actualities. For example, an increase in expense of 3.1% for the term of the contract, but the actual expense has an average reduction of 5%. Revenue is not calculated on gross potential income as it should be. Expense is overstated and not adjusted for the total kilowatts sold. Conversely, the assessor's enrolled value is supported by both the cost and income approaches to value for the subject property. I respectfully request the board to uphold the assessed value of $11,843,170 for the 2019 tax year. And as far as PG&E's needing renewable resources, chances are as most probable that they will need ampersand beyond 2031. Thank you for your
Thank you.
time and consideration.
Thank you very much. So, yes, yes, sir.
You know what the enrolled value was for 2018?
I can tell you the exact value if you give me a moment. For 2018, the original enrolled value was $12,204,600, and it was reduced to $5,784,600, and we could not see in our documentation how that came about. It was done by Mr. Austin, who has since no longer been with the assessor's office.
I understand that, but what was the final value here? Did you say 5 million?
$7,584,600. So it's almost $7.6 million.
Was there an appeal filed?
I don't believe so. Let me check.
Just to be clear, so you're saying the assessed value was 7.6 million in 2018?
Correct, revised by my Austin, yes.
And that's consistent with 2011 through 2017?
If that's what your document shows, yes.
So just to be clear, the assessed value of this plant for 2017 through 2018 was approximately $7.6 million.
And you never appealed on those?
No,
No, but
we-
I will verify. Yeah, no, I don't think so.
Well, this year we filed the appeal because they assessed it at almost 12 million. There was a $4 million increase in assessed value.
Your application says you think the value is 500,000.
No, I said in my 500,000?
Yeah, that's what it says. Is that what you have?
Okay.
Application
Oh, I'm
show
sorry.
$500,000.
Okay. I apologize. I did not realize it was 500,000. That was based on scrap value of the plant. Like I said, we've presented evidence on the discounted cash flow value of 1.2 million, the historic cost of 2.5.
You're scrapping the scrap value.
Yeah, yes. Yeah.
Right now, give me one number you think should be on the roll.
On the roll, our historical cost of 2.5 million.
Yeah, so from 2018 to 2019, you are saying it should be reduced from approximately was 8 million to 2 million?
Are we talking about 2018 tax year?
Yeah,
The previous year that was adjusted?
2018, yes. What was
Yes,
it? 8 million?
It was 7.6 million rounding,
Okay,
yes.
so you are saying that it should go from 7.6 to 2.2,
2.5.
2.5? Yes. Thank you. All right, we should be closing the hearing on this item, and let's have a motion on it. What do we like to do? Would you like to make a motion on it? Yeah, but do we need a motion for that, to do that? We can do it later.
Yeah,
Yeah,
we're going to go into closed session.
but we'll take the matter under submission.
Yes.
Okay. And, all right, can you make a motion to take the matter under submission?
I make a motion that we take this into closed session and discuss this after the meeting here.
Okay, we have a motion. We have a second? Okay, we have a second. Those in favor say aye. Aye. Motion passes. We'll take this matter under submission and let the applicant know the decision on that. Thank you very much for coming. Okay, before we begin the the next item, I would ask the applicant, people from Rio San Paulo, how long do you think estimated time you will take for your presentation, approximately? Short, long? Very short, okay.
Let's do it.
Like that, okay. And the next one, the first priority funding people, how much do you estimate your time? So that's short too. Okay, I think we can hang on to that for that long.
Yeah,
Okay, all right,
we've been waiting this long.
let's hear the next item. Yes. Well, let's conclude, let's take one more. J. Mario San Paulo?
What's the intention in terms of the closed session?
Can we do all of them at the same time? Yeah, right. It's going to take forever to come back and forth. Let's hear one more and then we can do it. Okay, you want to take one?
They're both, yeah.
Okay, what do you guys like?
I think we should take one at a time and go in and come to conclusion and then come back and get the next one.
I'm saying that.
Since they're all here, let's hear them now, and then we'll take it into closed session, all of them.
Yeah, decide one time. It'll take
I've never
shorter
done any
time.
of this before.
Yeah,
Other people have to wait here then,
Yeah.
while we are waiting here. They've been
Yeah.
waiting here a long time.
yeah, let's just go ahead and hear them all.
All right. Okay. Please state your name, county of residence, and your relationship to this matter.
Marie Sampalo. I live in Pacific Grove, California, and I'm Mario Sampalo's daughter.
Okay.
And I've never done this before. This was very interesting.
Don't worry, just be informal.
Yes, yes, absolutely. Yes.
All right, so the burden of proof is here on the applicant, I believe, so applicant starts first.
I think the burden of proof in this case is, yes, sorry. I'm
Is
thinking of the
applicant?
next one.
Okay, so we will start with you, ma'am.
That's me, thank you.
Yes, you let us know what would you like to tell us.
Well, from what my father told me, that the property value, it was valued at $15,000. And like I said, I've never done this before, and my father's ill right now, so there was not much discussion prior to me agreeing to do this. So, and I've never been involved in my father's business before, business dealings before. This is really the first thing. So I think it's valued at $15,000, looking at my notes, and he wanted both pieces to be valued at $10,000 because there have been no sales in the area. I tried to run some things really quick and find out if there have been any sales. When I believe he said, had it dropped in the past, you have documentation up there that I brought in from my dad?
Ma'am, what kind of property is this? Is this land?
Yes, I'm sorry.
Okay, no problem. Residential?
No, it's not. It is not commercial. It's just a vacant piece of property
How big is it?
in Coarse Gold and Oakhurst. I don't know. I think that's in front of you there. I'm not quite sure. I apologize.
No problem, okay.
Do we know the size of these lots?
I'm sorry, pardon
The
me?
size?
The size should be listed somewhere in that paperwork. I'm so sorry.
Okay, don't
He
worry
was
about it.
so prepared.
That's okay. You can be seated.
Yes, at the same time.
Okay, go ahead, the next.
Because I did notice in the back of the paperwork, my dad is requesting the exact same amount on both pieces. So to get it going, let's just both at the same time.
Okay, ma'am.
And right.
Have a seat there. We'll hear from the assessor's office, what is this about, then we'll go from there. Good. Well, she made the presentation, I guess. Do you want to say anything more?
Okay, so the reason being is because there is no sales in the area, and my father's getting ready for the end of his time. And so we are trying to take over things for him. We do not have the financial means to build on these pieces of property and will not. I'm 65, I'm not going to move. I'm not going to spec build, I'm not going to do any of that. So he's been trying to sell it for quite some time. And it's not that his funds have run out, they are getting limited. And so building costs have increased tremendously. My father would have never built on any of these properties. He was too old, actually, at that time to be doing any of that. So he bought them as a 1031 from Palm Springs, and with the idea that I would be in the general area of where my mother was, his ex-wife, to take care of her. They moved from Coarse Gold, that's why he purchased there, thinking that at some point my brother and I would retire, hence the two pieces, to be close to my mom. And that now she's in Turlock. So, and the cost has just increased tremendously since construction and plumbing and different things like that. There's no way that we could afford something like that. And there's no sales in the area from what I saw. We've put it, I think my dad's placed it on the market about 3 times, I think, and there's to no avail. So that's going to be my brother Mario and my responsibility.
Any question to the applicant? Anyone?
Well, on this estimate here, it shows the drilling? Yeah. From the applicant.
Yeah, from me. My father gave me that and to bring in, and that was what I think that piece right there was in regards to when I think 2009, when he wanted to bring in someone to
2008.
well drilling and things like that for us, because my mother had moved to Coarse Gold in 2004.
So for the record, Madam Clerk, we're going to mark this as 0-1.
Yep.
Okay, any questions for the applicant?
I'm still confused. This document is like in 2008, and it's for drilling a well. Is there any community, is it water been connected now to the city there?
No,
There's still no
No.
connection?
no.
Okay. And this is for both lots?
As far as I know, there's no water on both lots. Like I said, this was a quick conversation with my father.
Okay. You have any question to the applicant? No. Okay, ma'am, thank you. You can be seated. Assessor's office, could you please tell us about this property, what is going on?
Okay. Again, this is Tran Cooper, Deputy Assessors representing for the Assessor's Office. Do you have the package in front of you? No.
Which package?
It's coming. I'll wait for that to come to you first.
Okay.
It's a little package, not very many, but we're gonna fly through it really fast.
Okay.
Yes.
Exhibit A. So it's 2 acres. Oh, and 1, and 2 acres on the other, so it's almost 3 acres. That's 4 acres. 5 acres.
Okay, so we got it.
Okay, you ready? Mr. San Pablo purchased these two lots. Lot 1 on Deer Creek in 2004 for $86,500. And the other lot, also about in 2004, July, for $120,000. It has, as you know, it's increased 2%, no more than 2% each year. In actuality, the base year value is close to $150,000. But we have been enrolled this property for $15,000 for several years due to the turn in market and such. Let me see here. Mr. San Pablo has at various points listed the property for sales, and they can be found on page 6. Are you at page 6? It's on the left-hand side because Aaron is left-handed, so he numbered on the left-hand side.
There's no numbers here. Okay, got it.
Okay. I was confused the first time too. I'm like, what's the number?
Yeah, they're hiding. We got it.
Okay, so at various point in time, Mr. San Pablo have tried to sell these, and as you can see, in 2014, he listed it as for $112,000 for this lot on Deer Creek, and then you go to the left, and the latest listing in 2016, the asking price was $87,500.
Why are there two different prices? Is the listed price?
Yeah,
Is it
these are the listing price, and it's apparently Mr. San Pablo requested a lower asking price in 2016.
Okay, but do we have any sale price?
I will go through the comparable sale shortly, but we are just trying to show you they have been listed for sale at various points. And number 13? Number 13, just same thing for the other empty lot on Sunset. He has been trying to list them, and the latest listing, on number 13, let me get there first.
We're there.
Okay, the latest listing expire January 21st, 2019. The listing price was $64,900. We feel that the assessed value of $15,000, around $15,000, is justified by comparable sales, a vacant lot with no improvement, and they are on page 8.
Okay.
These are the sales price. As you can see, there's several. The value range for these lots are between $22,400 to $175,000. $15,000 is actually drop off of the lower end of this value range. We feel that that is reasonable for, especially if Mr. San Pablo have asking for a lot more than the $10,000 that he has requested as value.
Are these pretty close to the property in question?
Yeah, these are all in Costco and Oakhurst, yes.
Yeah, but how close are they?
Let me see if I can find that.
Aaron Hayashi, Madera County Assessor's Office. These sales are all the vacant lots in Coarsegold, Ahwahnee, and Oakhurst. There weren't enough in close proximity to the subject, so I just took the entire mountain area, just as an example of what is out there and what's being sold. These have been sorted from 0 to about 7 acres. And you can see on the right-hand column, some have wells, septics. A few of them are on the various water systems. So they're all of similar size, vacant, and within their sales from April 1st, 2018 through the end of March 2019. So there's no indicator that shows a value of $10,000.
What's the closest lot that you have out of these? The ones that you listed there, which one is closest to the subject property?
Well, let's see.
I assume it's in the hills, is a rolling property?
Yes, it's the Oakhurst, or the Coarsegold property is right before you go up the hill as you get into Oakhurst, and the actual Oakhurst Deer Creek property is almost near the Ahwahnee area. It's a couple miles past the intersection of 41 and 49.
Okay, so when they listed it at 87,000, they didn't sell it. That wasn't too long ago. When was this?
I believe Mr. San Pablo just let the listing expire.
Okay, so you are basing the price just comparing the sales in that area. I guess there is no other way to do it, so we can land.
Mr. Hayashi, the
Yes.
list you have here, all of these are far over the $15,000
Yep.
Yes, that is correct.
Okay. All right, anything else you'd like to add?
Do you have anything else?
Any questions for the assessor's office?
Well, I mean, if looking at the example or exhibits from the applicant, I mean, these are estimates of costs that would be incurred on any vacant lot that's not on a water system. So this really has no bearing to the value of the lot. I mean, I could buy a $100,000 lot with a nice view, and I would still incur these costs for the septic, the pump, and the excavating the land. It could be a lakefront property, $300,000 near Bass Lake, I would still incur these same costs. So these have no bearing as to the value of this parcel.
Okay. Okay, ma'am, would you like to say something?
I was looking at my notes that my father had given me, and there's also, I'm not sure, Aaron, Mr. Hash, which property it is, but I do know that there is, with no permission, there was a runoff of some kind where the water was being directed onto my dad's property, which is actually my property. And the pipe was placed there without any permission. And you can see that in a photo, and I think you have that in your left hand. I'm left-handed too. And there was no permission for that. And that kind of hinders sales as well. I know I'm not going to build on it. And there's also a guide wire over the property. I believe my father said it's by the driveway, which is also hindering the sale. And that's why my father is just, take it. I mean, I'm not going to build on it. I'm not going to spec build. I work 2 jobs. My brother Mario is still in construction at 70 years old. We're not going to build on it. And we can't sell it. So there is no benefit to us inheriting, or so that's why I'm here, is because he wants me to have the headache as well. And I bless him for that. But that was a pipe there that hinders the sale, also the guide wire over the property that hinders the sale. And I see no value in it whatsoever. I don't know where you had said that what the sales were. I don't have anything in front of me on that oh, I did. I'm sorry. Page 8? Okay. Get my fingers out there. Do I have to count them? Oh, the number's on the left. Oh, I see it too, and I'm left-handed like Aaron. You think I'd have gone right to that. I see it.
It's right here.
Okay.
Sorry. That's
No,
what-
don't be.
that's what-
No,
oh
it
my
was
God, what's the
me.
numbers?
You guys discussed that too already. Okay. So these here are the sales that you were speaking of. And where are the sale price? Oh, the sale prices, I see. So I couldn't find anything that was close enough. Where is the closest one to my dad's property? Just for my own brain.
Actually, probably the closest one is
I mean, I could leave and Google it all, but
is probably the July 2018 parcel, APN 064-120-005.
for 37,000.
Actually, it's the one for 22.4.
22.4, okay, I see
It's
it, I'm sorry.
smaller, and it has
And
Highway
Highway 40
41 frontage, so that's probably why this is the lowest sale. Because it being high traffic, right there on 41 would be a good indicator of why it's only 22.4.
So so would the PVC pipe, the piping that's there really, and the guide wires over the property, don't you think that would hinder any sales of the property? I mean, I do, but I'm not a professional.
Well, the guide wires were there when it was purchased, yes?
The guide wires were there when it was purchased. I don't have that in my notes. But the pipe was placed in to divert water, am I correct? Because that's what I wrote my dad was saying, but I could understand what he was saying.
This is probably the one they're both on cul-de-sacs, to allow the drain off from the cul-de-sac down the property. So, I mean, I would agree that it's not
Hindrance.
favorable.
Right, okay.
thank you. Do we have any questions for the applicant? Oh, okay, thank you, ma'am.
Thank you, sir. Thank you
All
very
right.
much. Do I go back to my seat or do I sit in here? Okay.
You have a seat, ma'am. So, are you ready to conclude, Assessor's Office?
Yes, I think we just request that you uphold our enroll value for 2019 because there's no support for anything lower than that value.
Okay, thank you, thank you. All right, we close the hearing on this matter, and what shall we decide, same thing? Okay, so make a motion on it?
I make a motion that we discuss this in closed matters.
I second that.
Okay, all in favor say aye.
Aye.
Those opposed say nay. None? Okay, so motion passes. We'll take this matter under submission and let you know the decision. Thank you. Okay, next is first priority funding. Just a few minutes, we'll have it.
one more person.
One more. Okay, so in this case, the burden of proof is on the applicant, I believe. So we'll begin with the applicant.
State your names for, please.
Sir, go ahead, state your name.
My name is Sean Pitzel. I'm the managing member of First Priority Funding LLC. I brought with me some packages for your review if you'd like to see.
You want to
Okay.
pass those on to us?
Exhibits.
Ask him how long did you think it does. Yeah. Thank you.
Okay, are we all ready?
Yes.
Okay, sir, let's go ahead, state your name again. And
My
your
name is
county of
Sean,
business.
S-H-A-W-N. Last name is Bidsal, B-I-D-S-A-L. I'm the managing member of the LLC, who's the entity who owns the property, First Priority Funding LLC.
Okay. Go ahead.
Yeah, just to give a little bit of background and history on this, we purchased the entire shopping center about 5 years ago. The shopping center had this additional pad which was undeveloped where the Starbucks is built. The entire shopping center is roughly about 95,000 square feet. The current assessed value, again, I give you the approximate numbers, is about 6.5 million. So price per square foot on this shopping center as of now is about $72 per square foot. So the undeveloped pad where the Starbucks building was constructed, it was constructed during 2019, and again, we are reviewing the tax roll of 2019-2020. The building finished around October of 2019 and that's one tenant, and was delivered to Starbucks and they start operating. So what I did is I put a package together to evaluate this property from two aspects, from a cost aspects and from income aspects. The first page I provided you basically summarizes both approaches. The property is a multi-tenant with the potential of having 3 tenants. One of those spaces, which is the Starbucks is currently occupied, is roughly about 1,800 square feet. The reason that we build it because we were approached by Starbucks. Really, we did it for them, and we decided to build it with a three-tenant, multi-tenant structure in mind. Starbucks has a great advantage on that site, and basically they have their own outdoor patio, and they also have a drive-through which is extensive in construction cost and also in valuation. So the other two spaces are they're considered shell building, meaning they are not fully improved for a tenant occupancy. The permits that was done was from the landlord point of view, was a shell building construction. Starbucks did their own inside work at their own cost. The other two spaces, actually all three spaces, were marketed before the construction for almost a year. It started in 2018. And with the exception of a Starbucks who wanted to be there, the other two spaces have not been rented for over a year and 3 months. That has been marketed. And one of the reasons is that we still have a lot of vacancy. We have about 26% vacancy or more on the main shopping center. Again, this is a part of it. This is an out parcel pad of a existing shopping center. It's not a standalone. It's owned by the main ownership of the shopping center. And we do have similar size vacancies in the main shopping center, and both that vacancy is still available plus the two vacancies on this multi-tenant Starbucks pad, and it hasn't been rented. So those two spaces are still empty. The only tenant is a Starbucks. Now, in terms of the GLA of the 5383 square feet, only 1,800 and so is rented to Starbucks. 3,500 square feet of it is available. So if you go to page 2, we have a limited history of running this building, mainly because the occupancy or the possession took sometime around end of September, beginning of October. So we only have 3-4 months of opening. But we do have historicals from the rest of the shopping center, which we own for 5 years. So we can create a budget, we can extrapolate and come up with a number, how much it costs to operate. Again, this is not fully done because we do need a year or 2 years of operating history to pin it down completely. But if you look at page 2, based on the rent we collect from a Starbucks, and the camp charge reimbursement and the current expenses, the projected 2020 income is about $57,000. And I had 2 discussions with the assessor over the course of past few weeks. Basically, his inclination of cap was 6.5%. We had further discussions about the cap rates, and just to give you a little background, I've been doing this business for 25 years, since '96. And I manage and own a couple of million square feet of retail nationwide. So I kind of have some knowledge and background in what cap rates are and how to evaluate and come up with numbers. So there is a distinction I like to make here for the panel, a few distinctions. The first one is how you evaluate from the appraiser point of view a single tenant, we call it a coupon clipper, versus a multi-tenant shopping center. People who buy a single tenant are passive investors who don't want to deal with running a shopping center. They just want an income, more like an annuity or a CD in a bank, and it demands and it fetches much lower cap rates, much higher value. So you can get a cap 6.5 when you have a single tenant. This is not a single tenant. This is a multi-tenant building, number one. Number two is a part of a larger shopping center with the same ownership. That's a big distinction because assuming in the future we rent the balance of it, it's not going to be treated, sold or appraised or mortgaged as a single tenant coupon clipper. So even though a single tenant Starbucks can fetch a 6.5 cap rate, again, this was a discussion I had with the appraiser, and I used his number and I put it in my paper, 6.5%. If you are treating it once it gets full, hopefully in the future, or if you're looking at the rest of the center, it's not a cap 6.5. It's a cap 8.5. Now, a good example of it is what transacted last year, which is Rancho San Miguel Shopping Center in the town. And that sold above 8 cap, 8.2, somewhere in that range. That product was much superior in a better street. It has an anchor supermarket, which is highly desirable. So comparing that with a small 5,000 square feet strip center, if and when we put this in a market to sell, as a 3-tenant, multi-tenant shopping center, it's not a range 6 cap. It's in a mid-8 cap.
Okay,
So I
Mr.
just wanted
Benson.
to make that point.
Let me interrupt you. When did you buy this property?
We bought the entire property about 2015, 5 years ago.
What year was it?
2015, I think.
Okay, how much did you pay at that
We
time?
paid 5.9 for it plus commission.
5.94 million?
Yeah. And it was roughly 95,000 square feet at $72 a foot.
And since then, you have made improvements for Starbucks?
Yes, we
there.
did. Yes,
Okay.
we did improve the property itself, the whole shopping center, the 95,000 square feet. We also built this thing. This is a new construction. It's not an improvement. It's a new construction. So that's what I put down in page 2, which is basically projected NOI of 2020. And I used the cap 6.5 as a single tenant, the way the appraiser wanted it. This is not a single tenant, it's a multi-tenant. At 6.5, I came with $888,000 value. And the next page shows a rent roll. Property is managed by a third party called Dana Butcher Management Company. The following page is a limited income and expense, mostly expense, running a 4-month period of the operation. Just to give you, basically I'm using this page to show you what kind of expenses we have incurred in the past few months. The following page, I'm using a different approach. I'm using a cost approach of the permits we obtained and soft cost, hard cost, and it's roughly about $795, it's almost $800,000. And again, I handwritten it right now, a few minutes ago, here, 3 different contrast valuations. The existing shopping center is at $72 value. What the assessor is proposing for the new construction, which is roughly 5,383 square feet, is $2,050,000, which is going to be a price of $380 per square foot. That's the proposed assessment that the
Okay,
assessor
excuse me. We need to stop right here. This is your opening statement. We hear you, what you're saying. Then you will be given a chance to make a full presentation.
That's
Let us hear from the assessors side what they're trying to say, and then we'll get back to you.
Perfect.
Have a seat, please. Okay, opening statement from assessor's office.
Hello, board members. My name is Tran Cooper.
Excuse me, has to be short, and then we'll come back to you. Just like he's saying that the value should be this is what he purchased, and he's explaining 3 values. So if you could briefly tell us in 5-10 minutes.
Okay.
Then we'll come back to you for full presentation.
Surely. Does Mr. Glover and Mr. Torres, either one of you would like to respond to that? You would be more familiar with it.
Like, what's the basis for your value?
Our value was arrived by using the discounted cash flow that we will be presenting in our presentation. Our value, the discounted cash flow show a value of $2 million accounted for the vacant spaces already.
Okay, anything you want to add at this time? Okay, so your contention is $2 million?
That's correct, sir.
Okay. All right. So now the applicant can make the presentation, full presentation.
Thank you, Chairman.
No problem.
So as I was saying, the shopping center's valuation as of now, the main shopping center, is about $72 a foot. The proposed assessor is at $380 a foot. Granted, this is a new construction and it costs more money to build it. We are proposing $1,017,000, which is $180 a foot. The assessor is asking us to pay taxes on $380 a foot, which is 500% or 5 times higher than the rest of the same shopping center. Now, I haven't read or reviewed what the assessor's package is because I just was handed, so I don't really know what's inside. I'm assuming they're using comparables. But up to this point, it's not realistic to have a multi-tenant building at $380 a foot when a shopping center is at $72 a foot. Now, it brings us to a different point. The assessor mentioned discounted cash flow. It brings up to 2 additional points. We are valuating this property as of tax roll 2019-2020. We are not valuating how much it's going to worth when it's full. It was marketed over a year. Those 2 vacant spaces have not been rented. So it's not going to be fair to give it a value right now. It's not rented. And it's in a shell space, meaning when a tenant comes in, it's going to require a lot more work, a lot more cost, whether paid by tenant or landlord, to bring it to a occupancy stage. That's one part. The other part is that let's assume, for the sake of argument, again, I disagree because I am going to evaluate this in a point in time, a snapshot of time today, 2019, 2020, not the future discounted value. But I'm going to discuss it in both ways. So based on today's snapshot, it's worth somewhere between 800 to 900,000. You want to give it an additional, put some land. Land was not disputed, it was a pad, $50,000 land. Add that to it, make some upward adjustments. I came up with a proposed value of $1,017,000. So again, I'm looking at it as what it fetches right now, what income it fetches right now from the income point of view. From the cost point of view, I've already provided the backup documents. That's a straightforward number. You already have that. From the income approach, we are looking at it from a point of view of how much it worth today, not how much it worth in the future. That's our point. That's our position. But let me argue it alternatively for you. Even if you are going to value future income by assuming that the other 2 spaces are leased, let's analyze that. How much am I charging right now? What's my average rent in the shopping center? Highs and lows. Let's say $12 a foot. You plug in $12 a foot for the vacant space, 3,500 square feet, it's about 42 grand a year. You add it to the projected NOI is about 99,700. Now you need to take that, if you're going to use a use pad or any other appraisal association rules and regulations, you need to give it vacancy, you need to give it reserve, you need to do it in a way that is the actual NOI, not something hypothetical. You need to give it a 10% vacancy, you need to give it a 2% reserve, you need to bring those down. You bring those numbers down, now you no longer can apply a cap 6.5 because that's for a single tenant. Now you apply a shopping center cap rate, like the rest of the shopping center we have, or like a Rancho San Miguel, or like any other shopping center. Then you apply a cap 8.5. You follow that formula based on Again, I'm not even using discounted cash flow, I'm using actual future cash flow, which is gonna fetch a higher number than a discounted cash flow, actual, assuming it's full, minus a 10% vacancy, okay? On a cap, 8.5 is gonna be a multi-tenant now, it's gonna worth about $1,047,000. I did the math myself, $1,050,000. I put down $1,017,000. My costs are running $800 to $900. No matter how you turn and twist it, you're not gonna get to $2,050,000. $2,050,000 is not realistic. You can go up and down, you can change numbers, you can make different assumptions, you can use different Excel forms. You're not gonna get to $2,050,000. You're not even gonna get to $1,400,000, $1,200,000. You're gonna be hovering around $1 million, plus minus. Okay? The rest of the packs that I provided is basically permit fees and how much we spend, which is factual, is there. I'd like to make some points. A couple of other points. What we are charging at the shopping center for at least 2018 till present, with the exception of Starbucks, we haven't been able to lease any new space. I think we are in negotiation to lease one space which is not occupied yet. Again, for that size of spaces, the rents are around $12, $13 a foot. Okay? And we still have to give them a TI money and commission and all that, and that's in the future. So if we have those spaces available and it's not rented, even though it's been marketed for about a year and 2 months, we can count that money today. Now, the appraiser can come back 2 years down the line if the building is full, if there are tenant improvements done, which is going to be reflected from building department because they have computers are connected, they can come back and request for a new assessment. And at that time, we can have the same discussion as we have here. But as of today, that's the number. It's not 2 million. I'm open to any questions.
Okay, sir, no, you have a seat, we'll have assessor give their side, and then you will get a chance to reply it. Okay, thank you. Before you begin, I have a question. When you use the income approach, do you use actual income or the potential income?
Potential, which it should be, how it should be calculated, yes.
The total
Potential.
potential for the,
Yes.
for the property?
Yes,
Okay, thank you.
you're welcome.
You have anything else that you want to add?
No, you go ahead with your.
Okay, as our son to present?
Yes.
Okay, you have our package?
Oh, there you do.
This one? Oh, you got it right.
Does Sarah have one? Barbara's hungry, he wants.
Do you have our package?
Yes, we do.
Okay, well, without being redundant, Trang Cooper, Deputy Assessor for the Assessor's Office, and I'm gonna not try to describe the property because I think the applicant have described it very nicely. The completions of this building was around October of 2019. On September 5th, 2019, Mr. William Clover sent a letter to the applicant to request for information such as floor plan and overall building and individual tenant spaces copy of leases or current rent roll with leases, term, and square footage, etc. We were provided with only a rent roll with not much detail, and it's that in your Exhibit A. Exhibit A, 5.
Okay, fine. Okay.
And the rent roll is on the next page, A6. So not with much info provided or communication from the applicant, Mr. Torres performed a discounted cash flow on income approach to value, and I can go over the discounted cash flow that we have completed to arrive at the value for you. That would be starting at Exhibit A, page 1. As you can see, the value is at $2 million and the cap rate of 6.5%. Do you see the two numbers? The value $2 million is almost at the top right-hand corner, and the 6.5 is highlighted in yellow on the terminal cap rate. On page 2, the 1850 square foot is occupied by Starbucks at $3.83 per square foot. And then we calculate it into the annual gross income. For the two remaining vacant space, one is 1,800 square foot and the other one is 1,556. We use market value of $2 instead of what Starbucks pay to make sure that we use market rate.
Excuse me, do you have comparable rents that you use in deriving?
Yes, and that would be in Exhibit E. All the comparable rent is in Exhibit E. You're welcome. Are you ready for me to go proceed?
Yes, go ahead.
Okay, so if you look at the bottom of the page, we did account for the two vacancy space with 64%, which is about 2/3 of the building not rented for the first year, and 1/3 left vacant after the first year. The second year, we give it a 33%, assuming it's not been rented at that point, with the stabilization vacancy of 5%. On page 3, because these leases typically at a triple net, we allow for 5% expense. On next page, page 4, we use an expense escalator of 2% with all the computations. The value, present value is $2 million as routed from this calculation. Also, I would like to note that we use the market rate because with the email from Mr. Clover to the listing agent, we couldn't see how much the asking per month rent is for these vacant space, so we do use the market rent of $2. Do you have any questions on the discounted cash flow?
Any questions?
No? Okay. So let's please turn to page comparable sale on Exhibit B.
Which one? B?
B, like boy.
What page we are on?
Big one, yeah. After the exhibit page, it should be the very first page. It reads commercial improved property comparable sales. Do you see that?
We see it, yes.
Okay, so there are 4 comps that the appraiser used to look at what's out there and what's the market's indicating. The subject is on the very left-hand corner. And then these com 1, com 2, com 3 are subsequent columns. I don't know if you have any question, but through the computations and adjustment for time and square footage, the market value has a range of $2.1 million to $3.2 million, and that can be found on the bottom of the worksheet where it reads indicated value, and you go to the right, it would say how much market value is this property could print, and the range is between 2.1 and 3.2.
This Marketplace Drive property comparable number 1, where exactly is that?
That's the Home Depot parking lot right above the, and the second one is Oakhurst, and the other 2 are similar. The one in Los Baños is also like within the shopping center, and the one in Merced is also just brand new and also opened in 2018, 2019 as well.
These numbers are sales figures?
These are closed sales
Yes.
prices.
Recent ones?
Yes.
Yes.
Okay, thank you. All right, okay, we got it. Next.
As Mr. Rowe asked earlier, we have comparable rent that we included in Exhibit C. In Exhibit D, we have a compute a cost approach to value, and would be D1. When you get there, please let me know.
Yes.
Okay, so we use Marshall and Swift as a national recognized D like dog.
All right.
We use the Marshall and Swift cost book as a national recognized cost valuation. The cost value indicate the cost approach indicate it takes $655,000 to build this building, but as we all know, cost doesn't equal value because these are the incomes generated property. The cost is not being given much weight. And Exhibit F is the...
excuse me, on the D1, then what you conclude on D1?
D1, it just showed you how much it costs. According to Marshall and Swift book, is how much it costs to build this building.
So you come with 655,000?
Yes, but we know it's not the most accurate information. It doesn't account for a lot of things that we should be accounted for. It's a general idea, but again, these are income producing property. This cost is just not the most accurate information, and we don't give a lot of weight to it.
Okay, go ahead.
Exhibit F. These are the listing that the applicant have referred to, and as you can see on page F1, the asking cap rate is 5.25%.
This is the asking price, not the sale price. Or is it sold price?
That's the asking price. These are the listing because,
Listed. Okay.
yes, we are just trying to show you that the cap rate is 5.25.
Mr. Glover appears to have something to add.
My name's Bill Glover. I work part-time with the assessor's office. I've been appraising for 49 years. I've also appraised this Basic Center about 25 years ago. The Basic Center was constructed in 1970, so it's a 50-year-old center. And if you've lived here in town long enough, which I have and Mr. Rowe has, that center has seen vacancies come and go as development moved away from this particular area. What Ms. Cooper is referring to in F1, the listing of O'Reilly Auto Parts, the applicant has stated that the subject property should have a cap rate similar to the 50-year-old shopping center, whereas the subject property is a brand-new multi-tenant standalone pad that can be sold separately. Likewise, the O'Reilly listing is immediately across the parking lot from the subject property. This property, again, is a freestanding parcel. This property was built in 1979, and the applicant, the list price for this property was $2,479,000, again, for a property built in 1979. And the cap rate is nowhere close to the 8.5% that the applicant is requesting for the overall shopping center, the subject property to be included in the shopping center. This cap rate is 5.25, which is quite a bit different from the 8. Now, this property had been listed for quite some time, and I just ran a check last week, and apparently is off market as of the 24th of last month. I'm not sure why, whether perhaps it's a sale or it was just pulled off the market. Relative to the applicant's income approach, the income approach that's shown is basically just considering Starbucks. The other thing that's not considered in here is that I've seen, as Mr. Rowe has, numerous Starbucks leases and inline space rents that typically go in this type of building. Typically, those expenses are triple net, and in some cases, as the applicant referred to it, they're coupon clippers, what we call. They're absolutely no cost to the owner. And in the income approach that the applicant used, we have CAM reimbursements, common area maintenance reimbursements, but we also have expenses in there. Under a triple net basis, those expenses would be passed through to the tenant. So the income approach that's used here is not correct. The state of California requires that we take a look at the property as of the date of appraisal. We have to consider the as-is condition that that property is in at that point in time. That point in time involved a multi-unit property, multi-tenant potential property with a national credit rated tenant in there. We have to appraise the property as it exists, the land, the building, and the tenant. The tenant in there is a national credit rated tenant with a 10-year lease. We don't know anything else about that lease because we don't have a copy of the lease. But having seen Starbucks leases, there's probably 3 5-year options with increases at each point in time. There may be an increase during the initial 10-year term of the lease. We don't know. We haven't seen it. So the state of California says in the Assessor's Handbook 502, page 82, under the heading Valuation of Properties Not at Stabilized Occupancy. The only time that we can consider a hypothetical value is in a case like this where we have a property that is not at stabilized occupancy. At that point in time, we are instructed by the Assessor's Manual, adopted by the Board of Equalization on page 85, that we estimate the market rent for that property. That is you can't use a hypothetical for fair market value, but this is the only case where you have to estimate a hypothetical rent for that vacant space. You do that, you arrive at a value, which is a hypothetical value, as if it were at stabilized occupancy. The property is not. Therefore, you can do a discount cash flow where you account for the vacancy and the rent up, which in this case, it took 3 years. We projected over 3 years using market rent for the vacant space. Again, I tried to contact the listing broker to find out what they're asking in rent for that space. I received no reply. So we had to use our best estimate that we could based on comparable rents, similar properties. The sales properties that you saw, most of those properties, especially the one out in the Marketplace Shopping Center, I believe it's Sale 1 and Sale 2 in Oakhurst. They're both new Starbucks. They're both multi-tenant properties. And so those were comparables that we looked to also. And you can see what the prices per square foot were. So in arriving at the discounted value under the income approach, the $2 million is considered to be, in our opinion, reasonable because we did what the state required. We estimated a fair market rent for the vacant space, and we took into consideration the vacancy and the lease up. And that was the $2 million that you see in the income approach. And like I say, the overall rate was a 6.5. That overall rate does not relate to the 50-year-old shopping center that the subject is a part of. It's a part of only to the extent that it is a freestanding pad. And that was developed with the Starbucks. And as you saw in Exhibit F1, an identical situation of an older property on the same parking lot. You can see them. They're within eyesight of each other. Had an asking cap rate of 5.25. We're at 6.5. The reason we went 6.5 is because, number one, we're not stabilized yet. So we gave them the benefit of the doubt. I don't recall what the cap rate is on the sale up in Oakhurst, but I believe it was around a 6. So, pardon? 6.1. 6.1. Okay. So we went to 6.5. To be on the conservative side, if you will, and that's how we arrived at the value. And again, we did what we were instructed to do through the State Board of Equalization, and that's how you value properties that are not at stabilized occupancy.
Okay. Thank you. Anything else the assessor's office like to add?
Not for me.
Any questions for us? No? Okay.
Thank you.
Mr. Birsel, it's your turn for rebuttal.
Thank you, Chairman. The assessor mentioned something regarding the requirements that they have to follow from the State Board of Equalization handbook. And he also mentioned something about assumptions he makes regarding these commercial leases of triple net. My company is not just an investment company, we are a property management. That's what we do for 25 years. The assessor is partially correct. Tenants' leases are triple net with one caveat. We have a term in our industry called leakage. Leakage means properties leak NOI, net operating income, when they are operated. Not everything that are part of the expenses are passed through to the tenant. There is a good portion of it which is called leakage, where the tenant will not pay. I give you a wide range of examples on that. Triple net pass-through charges are very limited to share of the property taxes and parking lots, and only the liability insurance. Leakage 1. As a landlord, when we have a loan on a property, we have to purchase property insurance and liability insurance. Tenants do not pay property insurance because national tenants carry their own property insurance, so they do not double pay. Part 2. When you have leakage 2, When you have vacancy, landlord pays the property tax for the vacancy, not the tenant. Leakage 3, roof, air conditioning, exterior of the buildings are not part of the triple net. Whatever happens to the roof leaks, or the air conditioning, or the graffiti, or the exterior lights, we pay for it and we do not get reimbursed. So it's not true to assume that everything is triple net. Now, that brings to a second point, which I brought up in my presentation, which I'm going to reiterate here, and I'm going to make it more clear. I made a distinction between a single tenant coupon clipper versus a multi-tenant. There are some single tenants where the tenant pays, they call them absolute net. There's a distinction between an absolute net and a triple net and a double net, single net gross. We got a range of them. This property is a simple triple net. I do agree. It's not an absolute net. There is a great deal of leakage in the income on this property. So that point I'd like to make. I'm going to go back to beginning of the pamphlet and explain one by one, but I'm just going to go out of order on one item, and that's the O'Reilly lease. The O'Reilly comp for sale is a part of our property. We put it in a market, see if we can sell it. It was a 3-month listing agreement. It didn't sell. We took it off the market. Nice try. Didn't work. It's not sold. We didn't get that kind of money. Okay? That's done. So that's not a real comp. It's just an attempt to see if we can sell it. Didn't sell. It's off the market. It's out. Different issue regarding a 50-year-old shopping center versus a brand new. I'd like to make 2 points on that. Number one, the main shopping center is originally built 50 years ago, but when we bought it 5 years ago, we went through extensive remodel. We brought it up to 21st century. Otherwise, we wouldn't be able to get tenants. And even though the product could be a 40, 50-year-old vintage, it's not a 40, 50-year-old product. It's up to date, it's modernized, it's remodeled. The other point is that if you're going to look at it from the point of view of sell, a buyer looks at it like going to shop for investment, looks at a new building versus the other building. It gives more value to a brand new building. 100% I agree with you. How much is going to give more value to a brand new building versus something that's remodeled? I agree with you, more, 100%. How much more? Is it going to give you $72 per square feet value to $380, or is it going to give you $72 per square feet to $180? I'm okay with 2.5 times more, but I'm not okay with 500% increase of comparing a new versus old. You have to give it some value, but you don't give it 500%. Okay? Now, let's talk about a buyer. A buyer looks at properties, and assessor is correct, it's based on tenancy, who's there. The Starbucks, really valuable, but so is Planet Fitness, so is the Dollar Tree Family Dollar, so is O'Reilly. These are all national credit tenants at $72 a foot, at 8.5 cap rate, not 6.5. I'm going to go through the comps, but just off track, let me make one example. When you are looking at comps, you need to look at really the last 6 months of a comp, not 13 years old comp. One of the comps, the first comp, is 2007 closing. 2007 closing is not a closing of 2019 or 2020. You're comparing apples to oranges. We are comparing apples to oranges in multiple areas, not just one subject. It's not proper, it's not consistent to use 2007, two of the comps are 2017. To use 2017 3-year-old comp and a 13-year-old comp to reach a predestined number, to reach a predestined cap rate and a price per square foot. What I'm saying is that those are not applicable. Those comps are not proper, they are not consistent, they are not applicable in this case. They're too old. Comparing an Oakhurst city with a city in Madera, the geography, the demography is different. They are not applicable. Those comps are not applicable. I do purchase properties all the time, nationwide. I can use that. I cannot use something that is 2 years old comp, something sold at 3 years old or 13 years old, or is sold in a different city to bring it in to justify my end. I can't do that. It won't work. Okay? So I just wanted to bring those points. But going back let me start from the beginning of this, because I'm only a few points. On A2, which is their discounted cash flow calculation, and I can tell you, I can testify, because I'm the one who gets LOIs. The 2 vacant space, the assessor is putting at $2 per square foot. We are not getting $2 per square foot. They are not offering it at $2 per square foot. And if they are offering it, we can rent it to them because we already have a tenant which is going to conflict in their exclusivity. I have an offer, yeah, $2 a foot for a pizza, but I already have a pizza. I can't do it, so it won't work.
But Starbucks is paying you over $3?
Starbucks is a different concept. You build the whole building because of them. You go to a different city and do development because of them. They are paying, but they are considered anchor. They are considered one that you go and build the building for them in your shopping center.
Can't you use that as a selling point that you have rented this for that?
We are, but we haven't been able to get another tenant paying anything near those numbers. Okay, so what I'm saying, plugging in a $2 hypothetical number is not proper. It's not consistent. We are marketing between $12 to $14 a foot for the inline space, with not much luck. Hopefully we get them. We are trying, but $2 is not proper. Hasn't happened yet. There is another side point to that, a smaller point, but I'm going to bring it up. The expense on that front building where the Starbucks is, if you're going to raise the property tax to $2 million, the triple net charges, the counts are going to be so high, local people are not going to go there. It's too expensive. When they can go to the rest of the shopping center, which is 95,000 square feet at $6.5 million, the property tax is much less versus coming to the front and paying 5,400 square feet for $2 million valuation. Their camp charge is going to be much higher, 5 times higher as far as the tax is concerned. You're not going to get it takers. Okay? So those numbers are not real, they are not really achievable, they're hypothetical. That's on page A2. Again, comparable sales, they are not sales that are in immediate vicinity within an acceptable geography, and also within a timetable that can be used as a comp. A 3-year-old comp or a 13-year-old comp are not real comps. B3, sold January 31st of 2006. B5, 2006. B6, January 2017, exactly 3 years ago, and 1 month. B7, same thing.
May I make a comment to that?
B9 sold in July 29th of 2016. Again, those are not real comps. Let me see if I have any other.
May I make a comment? Those are just ad flyer, so you, to indicate when the last sales was. These comp, if you look at page B1, the first page after the exhibit B,
B1.
yes. There's sale dates indicated on here for COM 1 is 7/1/2011, COM 2, 1/3/2017, COM 3, 7/29/2016. The most recent COM is COM 4, 3/28 of 2019. So those one that the applicant pointed out, those are just advertised flyer indicating when was the last sale when they advertise it.
They are mostly for just characteristic purposes, so you know what the property is. As far as him saying these are not actual comps or sales, these are closed sales at these prices.
Right, we got it.
I did not deny, I did not say that they are not comps. I'm just saying they're too old to be compared, and they're in different city.
Right, we got it. Yes, thank you. Okay, so anything else you want to add?
I think the property construction should be taken into, because it's recent, should be taken into account. I think there should be some sort of a relationship to what the current assessment of the main shopping center is versus the out parcel, which is not going to be 5 times over. Higher, but not 500%.
Yeah, you mentioned that, yes.
Yes. And I think I made my points on other issues. So.
Yes, sir. Thank you very much.
Thank you.
Okay, now do you have anything to add, Assessor's Office?
No, we don't.
No?
I don't.
Okay.
If I may, I do. Basically speaking, the sales that we used were all Starbucks. They all show a value range. The lowest value was the oldest sale. That showed at $334 a foot, up to $714 a foot for the Comp 4, which is a newer property. The subject property is a pad within an older shopping center. As you've lived here in town, you've known that that shopping center has always had vacancy issues, primarily because of the design of it, in my opinion. And like I say, I've appraised that property about 25 years ago, and they had issues back then of vacancy. You've got the L-shaped property with the corner over here that has virtually no exposure. The property has been updated. However, we're talking about a freestanding pad that can be sold separately from this. It is a new building with a credit tenant in there. And the applicant said that they're asking $14 a foot. Or $14 annually. That's $1.16. The question I would have for the applicant is, what are you asking for the remaining space in the Starbucks building? We have received no response from your listing agent. So I don't know what you're asking in rent for that spot. We had to go in and estimate market rent based on comparables of similar type properties in accordance with the procedures issued by the state of California. But we don't know what you're asking rent, so we had to make an estimate of market rent. That doesn't relate to what one of your hidden spaces over in the older center might rent for. We're talking about a new space on street frontage. And if anybody's gone by that Starbucks, which I did this morning, there's usually 10 to 13 cars in that line. There's a huge draw. And I congratulate you on getting Planet Fitness in there, because that center is now packed at night and in the morning. So you did well getting that old Mayfair building rented up. And but the other issue, the applicant referred to us using the listing of O'Reilly's as a comp. This is not a comp. We're not using it as comparable. We're only saying that in one thinking the applicant is saying we need to use an 8.5 cap or whatever it is because we have to blend it with the older center, yet this building is a part of that center.
You're just using that comp that.
We're just showing that we're at 6.5 on a brand-new building.
Right.
And they have a building similar to ours, although it's older. It still has frontage on I Street. It's an older building, and the asking rent, or the asking cap rate was a 5.2. There's a big discrepancy between, you know, what we want, what we'd like to get in asking price, and we use 6.5, somewhat being on the conservative side.
Okay. All right.
If I may answer
Mr.
that.
Bissell, yeah, now you can give your closing statement, so we can conclude.
Right. That is not a comp because it didn't sell. We put it in the market for about 3 months. It didn't sell. We pulled it off the market. That's not a comp to be used. The most current sale on a multi-tenant center in town, which people know, is Rancho San Miguel. That's about 8.2 cap rate, and it's a very nice building, by the way, and it's a supermarket anchored. That's a better comp than using Oakhurst or other cities from 4 years ago. What I'm referring to closed last year. So it's a lot more timely to the comps that the assessor used. Going back to the multi-tenant pad buildings that are used as comps, B9, B7, or the rest of them, yes, that's true. They all have a Starbucks, but people are not just going to buy it based on one tenant. They're going to see who the other tenants are. I have a center in Tennessee, Memphis, Tennessee, a Starbucks. They look at it as a Starbucks, but they say, who's your other tenants? I have Verizon there. This property has Verizon. The other property has Jumbo Juice. If you're getting second and third tenants national credit and it's valuable, yeah, you're going to get better value. We don't have that yet. We can pay a higher taxes for something we don't have. We tried hard. AT&T was supposed to go there. They backed out. They didn't come.
Okay, thank you. And your closing statement, assessor's office?
We would like to request that you uphold our enroll value of $2,050,380. Thank you.
Okay, thank you very much. Okay, we conclude the hearing part, and we're going to come to the board.
We have the last one that withdrew. We have not addressed that yet.
Oh, that one is withdrawn, right? Okay. So on this matter, we take into submission. Do we make a motion on this?
Number 6E, 5918, the hearing of Bryce Hovanians. I move that we withdraw that with applicant's request.
I second that.
Okay, those in favor say aye.
Aye.
Motion passes. We forgot to make a motion on 5930. The matter we just heard. Take into submission. So let's make a motion on take the matter in submission.
Okay, I move that we take the matter under submission.
I second.
Okay, all in favor say aye.
Aye.
Those opposing say nay. None? I got you. So motion passes. We will take this matter 5930 under submission, and we'll discuss this later. Thank you, and should we? It's okay. Should we?
I move that we close this meeting.
Should we
Adjourn to.
adjourn for
Adjourn,
today
yes.
and then, okay?
Adjourn to.
Closed session.
Are we reconvening? Are we reconvening after the meeting? Or-
Let's go to lunch.
It's going to be a long one.
Oh, sorry. Yeah.
Which ones?
Just move that we're gonna
Yes, so,
take into submission.
right. So that's why we're going to adjourn for 10 minutes.
If you want, you can still.
Continue?
No stipulations, you can finish the rest of the agenda and then go to closed session.
Okay.
Okay. Let's see, any non-hearing matters? You don't have any? Any staff reports or agenda requests?
Yes, sir, I have a really quick one. I would just like to update for the upcoming hearings. We have 7 remaining appeals for the months of May, June, and September. In April, we will have a meeting to go over the calendar for hearing for Canandaigua. It has been an ongoing. We're trying to set dates for that. And other than that, we only have 7 left for the next 3 months, May, June, and September.
Okay, thank you. Motion to adjourn? No? We're not adjourning? Okay. We'll take a short recess and reconvene. Right, recess.